Hi everyone, welcome back to the Market Chat. This is Richard, and today as our guest, we have Christopher Seifel, investment analyst at Titan Global Capital Management. He's somebody who I've been following on Twitter for quite a while. Definitely enjoy his deep, in-depth breakdowns of a bunch of very interesting topics, including machine learning. Christopher, thanks so much for coming onto the show and welcome.
Hey, Richard. Thanks for having me. I'm a big fan of your show too. And, it's been a lot of fun interacting with you on Twitter for the past, like 2 years now, whatever it's been. And, you're one of my go-to guys when it comes to technical analysis specifically. So it's great to finally be on the show.
Awesome. And yeah, I'm looking forward to hearing about your background as well as how your strategy has kind of evolved, because you've obviously got the fundamental side of things with the longer term portfolio, but we also talked about how you've got a more active management side of things as well. So really interested in getting into that. And to start things off, could you tell me a little bit about your background, your progression so far as an investor, as a trader, and yeah, just give me a sense of where you come from in your background.
Sure. So just a caveat, everything that, we're going to talk about is more just my views,
Right.
and just not related to Titan at all.
Yeah.
So my background, I'm not your traditional 2+2 bulge bracket, type of analyst, right? I come from a very differentiated background, which I think has served me well because it gives me just a different perspective on things. So I graduated from the University of Miami, 2013. I went down the banking track, was working at boutique for a while, did some corporate finance, and then where I cut my teeth on investing was at a family office where I was doing basically private equity for seniors housing facilities, everything from skilled nursing, assisted living, independent living, and that's where I learned how to truly fundamentally analyze companies.
Hmm.
And that was for about 3 years, and I was just really fortunate to have a boss that and it wasn't just on the fundamental side. It was really
Right.
just how to be a professional. Really
Right.
taught me how to communicate, be organized, be process driven. And all of that has really been the foundation for who I am as an actual investment analyst now, especially in the public markets. So the reason why I got interested in finance in the first place was, when I went to Miami, I wanted to be a sports agent.
Hmm.
And I was going to play baseball down there. I had 3 elbow surgeries. My baseball career was done. And so I got an internship. And that internship, I was introduced to the stock market and just fell in love. I was obsessed and still am today. And so when I was in the private markets, something was always missing.
Hmm.
I didn't feel that fire that I had, back in college when I was studying. So I basically made the decision really right before COVID to pivot. And it was interesting timing because, there was nobody hiring once March rolled around. But I was doing what I loved, and that's when I really started getting involved in Twitter and how we
Yeah.
met. And I just started doing these deep dives,
Hmm.
bringing my private equity framework and level of analytical rigor to the
Hmm.
public markets, and then started just expressing my ideas through Twitter, through the newsletter, etc. And that kind of evolved now into getting my job at Titan,
Hmm.
where I have so much to learn, and I'm so fortunate to not only learn from, my team at Titan, but also everyone on Twitter,
Hmm.
because I far from know everything. And that's the beauty of public markets, is that it's competitive learning is really
Hmm.
what it is. And so it's going to be 50 years, 60 years of just learning all the time, which is really what I'm passionate about, what drives me. So that's kind of how I got to where I am today. And in terms of my evolution as an investor, when I was, I mean, I was so far behind, where you are, and where different guys. I'm very good friends with Fiducia on Twitter. A really
Hmm.
young kid who's been investing for quite a while, and I would say I was very behind from that perspective. I was fascinated with markets, but I wasn't really applying it too much, I would say, about myself.
Hmm.
And once I got into the workforce, all my time was spent on just doing what the companies needed. And so I wasn't really in the public markets, and everything I did for my personal portfolio was more on the side. And my framework was much more driven by, we were taught in school much more of like a quote unquote value oriented type of
Yeah.
investment framework. You want to find companies they screen cheap, right? And it's so interesting to see how I've evolved and learned over the years, where I would say that inflection point really happened once I broke out on my own and I was focusing just on the public markets.
Hmm.
Because for the first, I would say about 3 months or so, I was focused just on learning, reading, consuming as much information as I could.
Mhm.
So really the foundational, I would say, materials and books for me was, How to Make Money in Stocks by Bill O'Neill.
Mhm.
One of my best friends, Jason Thompson, he's a PM
Nice.
at
Yep.
the O'Neill family office.
Mhm.
And he was really, I would think, the first person and really the anchor for me in terms of learning about the quote unquote growth side of investing. And the
Mhm.
reason why I put in quotes around growth and value is because there's no difference really in terms of what we're trying to do as investors. We're trying to find stocks that today we believe are undervalued relative to some point in the future,
Right.
right? The difference is how you get paid. On the value side, you're getting paid up front
Mhm.
by by paying a multiple or however you want to put valuation that is less than what it should be at. And then on the growth side, it's just on the back end when
Right.
you're really compounding moving forward. So he's really was the influence for me in getting into growth investing. And I read Bill's book and it made so much sense. And
Yeah.
for me, like if you present me with empirical evidence and you can show me that something has worked in the past, I can't argue with that, right? And
Mhm.
so that's really been I think, anchor in terms of how I look at, in terms of mental model, how do I look at my active portfolio, right?
Mhm.
Then on the fundamental side, my framework has really been refined, I think, to identify. The way that I put it is this: I look at long-term investments in my long-term portfolio, and then
Mhm.
I have my, I would say, more active portfolio where I think more tactical and looking for those more CANSLIM type of stocks that are.
Yeah.
You have the EPS growth, sales growth. You have explosive volume on a breakout from a traditional consolidation pattern.
Right.
And so on the long-term side, really what's informed my framework there are people like Yen Liao at Roth Global and Dennis Hong at Shaw Spring, John Huber at Sabre. Those guys I've learned so much from,
Mhm.
and I've been able to refine my thoughts around investing and identify just a few, you can call it mental models, but really just frameworks for how I think about long-term opportunities. And we can dive into it more later if you want. But really, it comes down to me, returns on invested capital.
Mhm.
People use terms like moats and competitive advantages, and that's all well and good. But really, what you have to do is find companies that are able to not only generate high returns on their current invested capital base, but on the incremental dollars that they are investing. They have to be earning higher returns on that as well. And that's
Mhm.
what a moat is. You can think about it as a legacy moat, then a reinvestment moat. And
Mhm.
that's really what I look for. And that shows itself through really one main characteristic, which is I want to find companies that are monopolies or structural oligopolies. And this is something out from Yen Liao. I want to say that none of the frameworks that I have or none of the ideas that I have are necessarily my own. Like I just adopt things that make a lot of sense to me that I've read and I
Yeah.
piece together from other great investors, right? So, Yen talks about he wants to find companies that are in unfair fights.
Mhm.
Like that's just such a beautiful way to think about it, right? Because
Mhm.
if you have a company that's in an unfair fight, like any sort of example, if you want like a low cost provider like Amazon, right? You If you're a smaller player that you're trying to compete with Amazon, that's an unfair fight. You're bringing a knife to a bazooka fight, right?
Right. Right.
And so that for me is really informative for how I look at my longer term investments. So yeah, that's kind of where I'm at today.
Yeah.
It's on my active portfolio. I'm taking a very much a CANSLIM type of approach, and I can quickly filter through ideas by just looking at those core fundamentals that Bill talks
Yeah.
about. And then what I'll do after is really dive in and do deep dives, which aims to identify those compounders, right?
Mhm.
Then on my long-term book, I'm using a similar framework, but I'm really prioritizing lower turnover because I want to let the names compound over time.
Right.
And so those are the names where I'm really looking at the longer term average returns on invested capital, the incremental capital dollars. I'm looking at free cash flow yields and the growth in free cash flow per share, that CAGR. And that to me can tell me what the longer term return profile is going to look like.
Yeah.
And I put actually in a spreadsheet my thoughts on the topic. if you look at it over time, like really long time horizons, and Charlie Munger talks about this, your return on that investment is going to somewhat mirror the returns on the invested capital, because returns on invested capital or earnings power,
Yeah.
it's basically just compounding intrinsic value. And
Yeah.
so over time, that's exactly what your return is going to look like. And so that's why I take a somewhat different approach for that longer term book.
Makes sense. Yeah, no, you put that beautifully. And we were just talking about before we press record here about Facebook and their kind of unfair advantage is that they have access to billions of people, monthly access. They've got a dedicated audience ready to buy their products, services, what have you. So, no, I completely agree with that mindset. Looking for those companies which just have that moat and just they are monopolies. They have completely control of a particular industry. So I 100% agree. I want to learn more about kind of what you do as an analyst over at Titan. So could you kind of go through, I don't know if you want to go through a standard day or kind of a project that you're working on, but what do you do as an analyst? How do you value companies? And yeah, what does your kind of normal work look like?
Sure. So I'll start by saying, not the luckiest person in the world, not Lou Gehrig, right? But I would say that I'm just so fortunate to be able to work not only at a great company with just all great people and an amazing culture with a really, big and audacious goal that is going to do a lot of good for a lot of people,
Hmm.
but I'm able to, for a living, do what I just love.
Hmm.
What I would tell people is, yeah, I'm getting paid for it now, but I was doing it for free before because there's nothing else I'd rather do.
Hmm.
So I get to wake up every day just beyond excited to go to work. So my typical day, I guess we could talk about it in terms of, what does it look like as an analyst getting up to speed at a company?
Yeah.
So what we do is we have three different strategies, right? And I don't know how it'll evolve down the road, but right now, the way we have it structured is we're all generalists, but we also have certain focus areas. So I'm very much focused on TMT, but specifically software and hardware and internet. And on the hardware side, mostly like semiconductors,
Gotcha.
which makes sense because I've been kind of all over that for the past almost year now.
Right.
But still, in terms of relative knowledge base, like one
There's
year
so
is
much to know. Yeah.
nothing.
Yeah.
It's unbelievable. But that's why I love it, right? Because once again, it's just like a constant learning curve. So that's kind of how we've broken up three different strategies is the names in my coverage universe are the names that fall into those buckets.
Right.
So the way that we're approaching it right now is, I'm kind of getting up to speed and ramping up in my coverage universe. And, we want to be not the smartest people on the street, right? Because you're not going to be. And
Yeah.
I think that you have to be mindful of diminishing marginal returns. There's definitely going to be a point where that incremental knowledge and the effort required to get that is coming at the detriment of you being able to add more value elsewhere.
Right.
So the point to where you can get to that right inflection point, it takes about anywhere from like 2 to 4 weeks, let's say, depending on
Hmm.
if I know the industry or not,
Hmm.
to really get speed on a name. And so that's kind of at a bigger picture what I'm doing at Titan on a daily basis. And that's aside from a lot of stuff that we're doing on the content side, which
Hmm.
I got a lot of experience in, obviously, with Twitter and my newsletter.
Yeah.
But content being, unlike whether it be a hedge fund or another asset manager or mutual fund, with Titan, what we're trying to do is, tell clients like, hey, like this is why we're making these certain investments. Like this is how we're viewing the world. And so we'll put together, different content around those topics, right? Just to make sure that
Hmm.
we're explaining our investment rationale very concisely for the clients. So aside from the communication side, at Titan, really what I'm doing is doing those deep dives that I was doing
Right.
before I joined the company. And so if I was to kind of break it down high level in terms of how do I go about the investment process or the research process, what I'll do first is basically just pull up the company's model, or I'll spread it from scratch, right? And what I'm really looking at are just very obvious trends in the fundamentals. A few things can pop out right off the bat.
Hmm.
How are the segments broken down? So how does the company think about the business? then you see obviously revenue growth, like what part of those segments are actually making up the majority of the company? What is the cash cow, right? What is the growth engine? And for me, what I'm trying to just understand first and foremost is, how does a company make money? Like, if you can't answer that very fundamental question, you shouldn't be moving on, right?
Right.
And if I don't know by just reviewing the financials, and I can't tell just based off the KPIs, like, okay, this is a transaction-based company, right? They have total payment volumes, they're taking a take rate off of that, or you have GMV if you're e-commerce and you're taking a take rate off that, or if you're a software company and you just have a number of customers, you have a certain, if you have certain modules, whatever it may be, average revenue per customer or ARR, different things like that. So I understand, how does a company make money? Then from there, I'm just working my way down the income statement. What's the margin structure look like? Are they growing margins over time? Are they more stable company? And then what I'm looking at are gross margins by segment. And what that's going to tell me is if the company has pricing power or not. If margins are coming under pressure, then the company doesn't have pricing power. And pricing power is a really big indicator of the monopoly or structural oligopoly type of company that we were talking about. Then I just keep working my way down. What does operating leverage look like? And for these software companies, they should have really significant operating leverage, because they don't, like, what are they spending money on besides sales and marketing, right? You should see like G&A as percent of sales going down over time. For me, I want to see R&D as a percent of sales staying high, right? Then you just keep working your way down. I go down to free cash flow, et cetera. Then I work my way down the balance sheet, cash flow. And so by that point in time, I have a very good understanding of how has the company performed historically, where are they at today? And then from there, I can do a couple different things that are really important to just frame my process, which is, one, how is the street currently valuing the company, and how have they valued it in the past? So I'm looking at multiples. And so what I'll do there is basically just do a spread of, over time, what have forward multiples look like at certain points in time where growth rates were different. And so I'm seeing, okay, so if the company was growing at 30%, this was the multiple that the street was giving it. When it was 40%, this was the multiple. And so from that standpoint, what I can do is understand, okay, this is kind of the incremental value the street is giving the company based off of how they view forward growth. And the key there is just understanding, how does a company trade? Some companies trade off of just sales. Some companies are some of the parts where you have to take like a percent of GMV, et cetera. And so all of this valuation work to understand how is a street valuing the company is so critical, because you can't go into an investment, right, and slap a PE multiple onto a stock if the company doesn't trade off of PE. Like, you're going into investment blind if you're doing that, right?
Like, so a lot of software companies, PE is like useless. It's all revenue type deal, right? Yeah.
So this is something that I don't really understand when I see it on, let's just say, Twitter, right? Because that's where we really consume the majority of our investment, interactions with people. So when it comes to PE, you're going to obviously want to apply it more to, if you would think about maybe a mature company, right? Because you have to have earnings in the first place. When it comes to software companies, a lot of them are, they're valued off of revenue growth. Specifically for me, I want to see free cash flow, because free cash flow is a better indicator of how the company can actually create value and capture value off of revenue. Because any company can grow revenue. If I sink 150% of my sales, of my revenue into sales and marketing, then I can grow revenue all day. But can that company grow at the same rate by not spending all that money? And so that also gets into just more analytics around like payback periods, et cetera. But I'm really looking at more sales or free cash flow type of multiples or yields for software companies. The difficult thing with using gross profit, which I prefer to do, because that gets into more unit economics, is that, and I can give an example, companies just report COGS differently. For instance, Fastly and Cloudflare, one company reports their discounts for customers in COGS, where the other one puts in sales and marketing. So it's not apples to apples.
Right.
So you can't just pull up multiples and say, oh, well, this company's trading at a higher gross profit multiple than the other, when you're not seeing the same costs in COGS. So yeah, for software companies, for the most part, you're going to be looking at a sales multiple or a free cash flow multiple, something along those lines.
Mm-hmm.
The reason why you also really shouldn't necessarily be using PE is because if you think about maybe a older school type of company, right? If you think about like your older blue chips, right?
Yeah. Yeah.
The quote unquote like R&D really shows up in CapEx.
Mm-hmm.
So you don't have that major expenditure affecting the income statement or the P&L earnings, right? But for the companies today, like these software companies, your quote unquote CapEx is really flowing through in terms of R&D dollars, which are going to be bringing down your PE. So it's not, once again, it's not apples to apples.
Right.
The investments that are being made by the company are affecting its income or its earnings, not CapEx. Free cash flow adjusts for that, right?
Mm-hmm.
There's some math differences, but in general, your free cash flow kind of adjusts for that. So that's why I prefer that metric. And so yeah, PE is just not a useful metric for those types of companies, right?
Mm-hmm.
And so understanding how does a street value this company will then inform how I'm going to value the company.
Yeah.
Because unless I have some, base rate of a company or industry being re-rated off a certain catalyst, I'm not going to be doing my valuation work off of a multiple that the street doesn't use. So does it make sense?
Makes sense.
Because you have to play the hand that you're dealt. You can't play the hand that you want, right?
Mm-hmm.
And so like I could want to forever and a day use a PE multiple, but if the street doesn't, like I'm fighting a battle I can't win.
Right.
So that's really a critical part of the beginning of my process, right? And so related to that, but really not the same thing, is I then look at, okay, if this is what the company or what the street is forecasting. So I'm looking at forward consensus. What does that imply in terms of the price? And this kind of gets back to an informative, one of the most formative books that I've read on valuation, on investing, et cetera, is called Expectations Investing by Michael Mauboussin and Al Rappaport. I think everyone on Twitter who follows me knows my just obsession with Moat's and all the work that he does on the investing side. I think the guy's absolutely brilliant. And everything that I do in terms of a starting point for my valuation work is price implied expectations. So based off of the current, it's really NOPAT, right? Based off the current projections of cash flow for the company, what would that imply in terms of the price today?
Right.
And then, so that's one way to look at it. And then you can see, well, what's the premium or discount to that price? The other way you can look at it too is what he calls a competitive advantage period, which is how many years of free cash flow generation are required to warrant the current price, right? And so if you think about the long-term average of companies, I think it's around like 8 years is what's implied in the stock price, which is pretty amazing because there's a lot of just news out there and data how not only are holding periods coming down, it's like less than a year or something crazy like that,
right?
But also the average duration of a publicly traded stock has come down materially over the past 50, 60 years. But yet still investors are giving companies about 7 to 8 years of free cash flow as their valuation kind of barometer. So what you want to see then is, well, what if a company has an implied competitive advantage period of less than that, of say 5 years or 4 years? Then you can think to yourself, well, then the street's not giving the company enough credit, and there's a value gap there, right? And so that's another way that I think about price implied expectations. So, and then you can do also like reverse DCFs. Reverse DCFs are helpful if they're already free cash flow positive, because it gets really wonky if it's negative and you're kind of basing it off of forward growth rates, because then it's just really not apples to apples. But you can use a reverse DCF to see, okay, well, this current price implies a 30% CAGR over the next 5 years or 40, whatever it may be.
Right.
And then it's very simple. Instead of you having to make all these assumptions around valuation, right? Which is, back in my banking days, I could create a DCF and get you any price you wanted.
Yeah.
I can just change the assumptions and boom, like there's the price. Great.
Right.
But with price implied expectations and reverse DCFs, all you're really doing is saying, okay, well, this is what the market currently thinks. What's my view? And it's much more of maybe not a binary type of analysis, but you're minimizing the number of assumptions that you have to make.
Right.
And so you're minimizing the ways that you could be wrong.
Mm-hmm.
And so that's really important because we're going to be wrong all the time.
Oh, yeah.
And instead of having to have 5 or 10 things go right for you, you just need to have a couple.
Mm-hmm.
And so your probability of being right just goes up.
Mm-hmm.
So that's really the first thing that I do is really, what's the business model? How does the company make money? That's just critically important. And then how is the street valuing the stock? And what are kind of my views around what the street's implying in that valuation?
Mm-hmm.
That's my starting point. And then I do and then from there, it gets into a lot of the fundamental analysis. So, I'm reading through the Ks and Qs, and I'd say maybe the most important thing is looking at like the latest earnings 8K and the earnings transcript. And what I'm trying to figure out is what is the key debate surrounding the stock, right? Because that is where you're going to have either a different view compared to consensus, or you have the same view as consensus. Like most of the time, like I'm going to say this, most of the time, and this is something I get confused about all the time, your view should probably be very close to consensus because there's information symmetry out there. Like there are very few stocks, especially larger cap names, where you're going to have an informational advantage. It's mostly not going to happen. So most of the time, I'm going to shake out to be very much in line with consensus. And there's usually no investment to be made. Unless, and I can get to this caveat later, but there's kind of one big caveat. So that's kind of where my starting point is what is the key debate? And then from there, I'm figuring out in the Q&A and the earnings call, like if you're a good analyst and you're just kind of reading through the earnings call, you can see what these analysts are really trying to be focused on. And I mean, you can go through different examples, right? But once I know that, what the key debate is and what are the key questions that I need to answer and figure out, that can then guide the rest of my research process, right? And so, I'm doing a lot of different things after that on the fundamental side, whether it be, reading through different sell side reports or, obviously consuming all the presentations the company's done. And I go back anywhere from, the past, 4 to 8 earnings calls. I'm reading through the transcripts, reading through the 8Ks, like all of that, and really consuming as much of the more near-term information as I can. If I was to go like incredibly deep, right, and I wasn't getting ramped up on names, I'd preferably go back to the S1, right, and just I would read starting there. Like this is an ideal world. I would start with the S1, and then going forward in time, what I could do is say, okay, well the company said they want to do this, and I can see if they actually executed on that, and that for me informs the quality of management, right? So that's an ideal world, but usually I don't have that amount of time. It's really, okay, what's the key debate today? And how is that going to look going forward? So I'm reading through all these different primary sources that I'm trying to figure out. Then from there, that should probably take me about 1 to 2 weeks, let's say, right? Preferably like 1 to 1.5. From there, I'm hitting the phones and I am trying to, but also using TGIS. TGIS is really helpful in this kind of part of my process as well. I'm trying to figure out what is the bull and bear case for the stock. How do the bulls and bears on the street, like what are their views, right? And that is very much tying into the key debate because the different perspectives will be around this key debate on the stock. And so I'm looking at analyst coverage, who has buy ratings, who has sell ratings. And if I can't find a lot of the data up front on them or like find their research reports, then I'll try to give them calls or just like reach out to them on Twitter or LinkedIn, whatever it may be. And I'm really trying to understand what their views are. Yeah. And because I already have mine, right? I'm trying to think and then poke holes in my own thesis. Am I right? Am I wrong? Am I missing something? And really, it's always asking why, right? It's always just digging deeper and asking why, like a 5-year. And I think with Toyota, it's like the 5 whys, right? And if you ask why 5 times, you should get down to that first principles basis
Right.
on a topic. So I'm doing that for the sell side and also for the buy side. So like pulling up ownership data and saying, okay, like these are the, the funds that own the name, right? And I know MarketSmith has this too, which is so helpful. And then I'm trying to call analysts or get in touch with analysts at those shops. Luckily, I have a good number of relationships just through the networking and Twitter, et cetera, where I can call up buddies and be like, hey, man, like, are you guys covering this? How do you think about it? And so by that point in time, once I'm done with all of that, I really have a good feel for, what's going on with the name, where are the different risk areas,
Right.
Which is the most important thing that you can do when investing is you always have to be focused on risk first. And then so from there, I'm basically done with my core research, right? I know the company fundamentally well. I know the industry really well from the first part of my process. Because I didn't add to, in the first part, I'm going through all the company materials and obviously you're coming across the competitive landscape. And I talked about going, top down through the company's financial statements. But what I'll do also is do the same thing for its competitors and see how they kind of stack rank and compare to their competitors.
Right.
Then I'll kind of flip that on its head and I'll like invert it and say, okay, well then top down from the industry level, like who's the winner and who are the losers and where's the company today? And could that company be number one, right? Because I don't want to invest in a company that isn't the best in their industry. Like, why would I, right? I'm trying to, once again, find unfair fights. And so once I get done with the sell side and buy side and really understanding the core debates and the bull and bear case, et cetera, then what I'm doing is really fleshing out my model. And my model, I used to have a very like euphoric view of modeling. I thought it was the coolest thing ever. I loved it. I thought I was the man. Once I could integrate a full like 3-statement model and do all that work, I thought I was the coolest person in the world. But modeling is actually, I've obviously changed my views a lot, but modeling is even more fun for me now. And the reason why is because the first, 2 main parts of my process that I talked about, you're really in consumption mode. You're in data gathering and you're consuming a lot of information. And what I've made sure to do and what I've really come a long way on is actually making sure that during that consumption phase, I'm also in creation mode, where I'm also trying to put ideas in my own language and my own views. And I think, we were talking about this before. It's with that, the ML and AI primer I did. I'm trying to put it into words that I can understand. And if I was to explain it to like my mom, for instance, like how could she understand it? So that I make sure that's truly understanding. It's not knowledge, it's like wisdom, right? It's applicable knowledge. And so what I'm doing in the modeling side, it's creation, right? And so I'm taking everything that I've learned and I'm creating views on it. And a lot more research does happen once I'm in the modeling phase, because the way that I approach modeling now is it's not just, what I would do before in my younger days in banking, just slapping growth rates onto sales and assuming some like flat gross margin and, some specific operating, expense margin and going from there. What it really is, and maybe I should start with this too. I don't think I mentioned this. My thesis for a stock or for an investment, it centers around, let's say, like 2 to 4 critical factors. And this comes out in this initial research, right? It's what are the 2 to 4 things that really drive the stock, right? It's not like revenue growth is not a critical factor, right? There's something that's happening to cause revenue to grow. And so from a very, you can use the term first principles, but from that kind of standpoint, what are the 2 to 4 things that are really driving the stock? And this kind of goes back to also price applied expectations. They're value drivers. And the value drivers at the end of the day come down to revenue growth, margins, and investments. Right. Either the level of investing or the duration of investments. And so I'm focusing on that, the 2 to 4 things. And I'm really getting pretty granular and thoughtful on just those 2 to 4 things,
Mm-hmm.
right? That's where the majority of my time will be spent. And for that, I'm once again getting on the phone. I'm asking questions. I'm calling IR, I'm calling management, I'm calling experts,
Right.
doing a lot of expert calls, reading through TIGAS transcripts. And, for, let's say, like for software, right? I actually just talked to, Muji and, Peter Offringa, Stack Investing. I'm talking to them to try to understand, okay, well, how is this going to shake out over time? And
Mm-hmm.
that can then inform how I'm either thinking about either market share or bottom up type of growth
Mm-hmm.
in terms of new products, what that pricing power will look like. And so spending really all my time on those 2 to 4 things.
Mm-hmm.
And then from there, what I'm doing is, for anything else, whether it be like, SG&A expenses or G&A, like a lot of these really, they're parts of the model, but something that's not going to drive the stock
Mm-hmm.
necessarily. I'm really running just a lot of correlations and looking at like, what can I tie this to have it grow and make sense? And so that's where I'm driving those kind of line items off of. I'm not really getting granular with it because it's, once again, how do I maximize my return on time spent?
Mm-hmm.
That's like something I got from Dennis Holland, like always being critically focused on what is the value, like what is the, we talk about return on invested capital. What's the return on my time?
Right.
The most important resource I have. And so if I'm not getting a big return out of modeling out SG&A, like why am I spending a lot of time on it? I shouldn't be.
Right.
So that's the approach I take to at least the modeling side of it. And then the valuation work, I'm doing a lot of the things that I've already talked to you about, which is really more just blowing out again the price implied expectations, the reverse DCFs, et cetera. And then I'm much more now, after building my model, I can then really easily stack rank. All right, this is what I think in terms of like a 5-year growth rate. This is what, the reverse DCF implies.
Right.
What's the disconnect there? And then what can that imply then in terms of a valuation difference?
Mm-hmm.
So that's kind of one way to think about it. Another thing that I'm doing is I talked about looking at, for, historically, when this was the company's growth rate, this was the multiple that was being applied. I use that analysis to then apply to my model, right?
Mm-hmm.
And I'm building a bunch of different cases off of these critical factors, the bull case, bear case, base case, management case, et cetera.
Right.
And so from there, I'm really building out a pretty big matrix of different valuation conclusions,
Mm-hmm.
and then applying probabilities to the different cases. And I'm getting to somewhat of like a blended type of IRR.
Right.
And so what I can then have is, and this is kind of what we finally get to, right? Because I don't believe in point estimates. Like there's nobody that is going to be correct on a specific price target if you're not like just completely lucky and by chance, right?
Mm-hmm.
So based off my bull and bear case, or even like bull, bear, and management case, however you want to put it, and the probabilities thereon, I can look at what my skew is based off of my IRR.
Mm-hmm.
So if my IRR, for instance, is like 30% on my bull case, and it's 10% on my bear case, it's like a skew of like 3, right?
Mm-hmm.
And so the higher the skew, right? You just think about it in terms of asymmetry. The higher you're going to have in terms of probability of a successful investment outcome.
Mm-hmm.
It's another way to think about like your R, right? If I think that I have a potential loss of 1 and I have a potential gain of 3, that R is going to be 3, right?
Mm-hmm.
Just simple math. And so that's a lot more of like that valuation type of work that I'm doing. And then there's like a lot of other things too that I'm just kind of thinking about in terms of like my mental models.
Mm-hmm.
And so like from there, just to kind of summarize it, because I've been just going on and on with my process, from there, I'll do like a write-up and investment memo, and really, once again, focusing on those critical factors, what's driving the stock. Maybe put together like a quick little, pitch deck, and then we'll go to investment committee, and then just talk about the name, et cetera, et cetera. And if we all agree on and we do pre-mortems and we go through this whole, pretty in-depth process. If we get to a point where the team agrees that, it's an appropriate addition to the portfolio, what I'll also have with me is like a recommendation on where should we trim, or what should we get rid of? What should position sizing be? all of these things kind of go into that decision-making framework.
Mm-hmm.
And that's for like a new name idea. If it's just, me getting ramped up to speed on a coverage universe name, we're not going to investment committee. I'm just, once I get to the point where I have my model built out, then I'm moving on, right? And so I'd say like that's like soup to nuts kind of how I'm going about the investment process. It's focusing on risk. It's understanding how the street is looking at the name and valuing the name, and really comparing how I view the stock compared to the street.
That's so fascinating because it's completely different than my personal process in deciding whether investment or trade is worth it. I mean, my process probably takes 30 minutes or even 30 seconds really. If I just look at a screen on MarketSmith and see whether there's earnings growth, sales growth, and then the price action to me kind of incorporates everything that you kind of talked about. What is the street looking at something? How are they valuing the stock? So it's so interesting how different your process when it comes to analyzing company is than the classic kind of CANSLIM approach.
Yeah. And it's funny you say that too, because that's my Titan process, right?
Yeah.
And that's my very like, long form due diligence process.
Deep dive. Deep dive.
Yeah, my deep dive, right?
Yeah.
But for my personal portfolio, I'm taking not a different approach altogether. That is still kind of the way that I approach the due diligence side of it.
Yeah.
But what I'll do on the personal side, because it is so easy to just miss the boat if you're taking too long on the investing side, on the research side rather. But I'm doing actually really a lot of what you're talking about for my personal portfolio, being, I'm looking at, I'm maybe not doing screens, but even just like the IBD 50 or whatever it may be. Mm-hmm. I'm trying to find stocks that are showing that explosive EPS and sales growth over, the prior quarters and also the trailing couple of years.
Yeah.
And then, looking at liquidity and all, using the CANSLIM type of approach, doing that quick screen and finding those really solid setups. And then what I'll do is I'll start pyramiding into the name. And while I'm doing that, I'll start doing that in-depth
deep
research,
dive. Makes
right?
sense.
So that I'm not missing out on stocks that I think have that really explosive, even if it's just more shorter term. I'm not going to be like kidding myself into saying, you know what, in this actively managed portfolio, I'm going to hold names for 3 to 5 years, and these are going to be the names that have the perfect setups today. We know that market leaders change, right? And I don't want to miss those names. So I'll take a starter position and start pyramiding into a name while I can then do the deep dive research and make sure that I can confirm really what I'm seeing through the CANSLIM kind of screening method, right?
Right.
And I think maybe people are asking, well, then what's the point of doing this deep dive research if you can use CANSLIM and just find those like really fast growers, right? And those true market leaders? The reason is this, because if you are going to find if you're going to find a monster, right? If you're going to find like an NVIDIA or an AMD, like pick your massive like TML, right?
Yeah.
If you're going to hold through those inevitable drawdowns, right, of 20, 30% after you've already had, like, this is after you've had like a 70%, 80% gainer. If you're going to hold through that 20 to 30% drawdown, maybe you've taken some chips off the table, and we can talk about kind of how I think about that. But the only way that you're going to be able to do that is if you have built conviction. And the only way I can do that, and I think the only way anyone can do that, is doing that deep dive research, right? I see the confirmation bias nonsense on Twitter about, well, Amazon has had, 90% drawdowns like X number of times, but if you just held on to it, like this would be your return. Yeah. Listen, that sounds great. In hindsight, it sounds beautiful. Oh, I was strong enough to hold on to Amazon when it had a 90% drawdown. Well, there are a few things that are wrong with that. One is, when it was in that 90% drawdown, I can guarantee you it was not a $2 trillion market cap that had AWS, it had a massive share in e-commerce. No, like there were a lot of questions around Amazon around that time, where it had negative free cash flow forever and a day, and investors were upset about it. And usually that's what's happening when these stocks have these massive drawdowns, aside from, a big like recessionary type of event like the Great Recession, or, even like when the Euro crisis hit, or even March 2020, right?
Mm-hmm.
So in order to hold through those types of events, if you're going to, you have to have the conviction. And so that's why I have to do those deep dives.
Makes sense. Makes perfect sense. Um, and I want to bring it back a little bit to your background because first of all, I love your mindset, your approach to like learning as much as you can. I think that's awesome.
I'm
Eh,
addicted.
yeah, for sure. I could tell a little bit, but I feel the same exact way. This is awesome. But I want to actually bring it back to your sports background and to ask you whether that kind of influenced your process in any way, your mindset, how you approach failure, mistakes, all of that, because I think that's so important to deal with as a trader investor. As you said, we're all going to make mistakes and we're all going to have ways we can improve. So did that influence your style, your approach at all?
Oh, 100%.
Yeah.
Trying to think about how to frame this. So I'd say the most important thing that I've done
Mm-hmm.
in, say, the past year or so, right? And I was telling you before, I think before we were recording, that I've grown more really since COVID hit. But the right way to think about it is since I broke out on my own
Yeah.
and started, controlling my own time and just really focusing only on the public markets. In line with that, and I've grown more since that time over the past, let's say, a year and a half, than I had since I graduated college, the previous like 6, 7 years, right?
Mm-hmm.
The reason why is really, you want to find things in life,
Mm-hmm.
and also in your investments, that there is what I would call like a big like leverage factor, right?
Mm-hmm.
And so what that means for me was, and this is another thing I got from Yen Liao, is really focusing on meta learning.
Mm-hmm.
So when it comes to meta learning, what I've done is, excuse me, I've learned a few different things. One is how to speed read, and not at the sacrifice of comprehension or retention. That
Mm-hmm.
is all a part of it. Speed reading, memory. I've developed a lot of different tricks and tools to have better memory,
Mm-hmm.
which is a huge game changer and advantage when it comes to investing, because, like, we've talked about, it's really competitive learning,
Yeah.
and different things like that have allowed me to really have a foundational, uh, really leverage point that I can use to then learn faster, right?
Yeah.
But along those same lines, another thing I've done is really change my mindset. A great book that I've read is called Mindset by Carol Dweck. This was actually, I think, a Yen Liao recommendation. And it comes down to having a growth mindset. And a
Mm-hmm.
growth mindset means you're not focused, like, it doesn't matter if you're
Mm-hmm.
right now, right? What matters is that you get to being right. Like, if
Mm-hmm.
Richard, if you and I are talking about a stock, right?
Mm-hmm.
And you think that you have all this data to back up why you think that you should be bullish the name, and I'm saying no, like, you have to be bearish. Instead of
Right.
us like talking at each other, right? I'm actually trying to truly understand, what are you saying? What is your view? Why do you think this way, right?
Right.
And it's always focused on learning and getting better and
Mm-hmm.
improving.
Mm-hmm.
And this obsession that I have with just always getting better and improving and learning and growing really does go back to those sports days.
Mm-hmm.
Because the way that I thought about it back then, and why would I get up at 5, 6 in the morning to go hit in the batting cages before I had to go to school? Because every moment that I wasn't working, there was someone else that was working that was getting an edge up on me. And so I probably have one of the crazier work ethics of anyone that I know, because I always have this thought, well, there's someone that could be outworking me and
Mm-hmm.
doing better than me. And if we're in a competitive learning environment, I can't have that, or I'm going to fall behind, right?
Right.
And then when it comes to, there are so many different ways that my background's informed this, in terms of sports. When it comes to the competitive advantages of a company, right?
Mm-hmm.
What are you doing when you're like creating a game plan, for when I played football back in high school, right? What you're trying to do is identify the strengths that you have versus the weaknesses of other teams,
Yeah.
and you're trying to find ways to exploit those weaknesses. What we're trying to do as investors are trying to find those areas of opportunity that we can constantly exploit, right?
Mm-hmm.
It's developing these right tail strategies that you have an advantage in not every single time, but for the like higher probability that you'll have this advantage whenever you find this type of setup. And it's
Mm-hmm.
very similar to that, right?
Yeah.
And then if you're not, once again, back to the growth mindset, if you're not taking this constant improvement type of framework to either sports or investing, then you're going to fall behind and you're going to have massive blind spots because of just the inherent biases that you're going to develop.
Mm-hmm.
So for me, and I think this shows up a lot on Twitter, I am wrong a lot.
Mm-hmm.
And I think to have a growth mindset, you have to be able to admit that. If you can't admit that to yourself, you are going to make mistake after mistake after mistake, right? And it's really bizarre. It's crazy to me that there are a lot of people on Twitter that somehow have a 100% hit rate. They've never been wrong. It's truly incredible to me. But for me, I'm trying to make this public so I can learn from it, so that other people can be like, listen, you're like, this is where you went wrong. This is how else you could think about it, etc.
Mm-hmm.
And so it's very, like, my background very much has informed that. And I think a big part of it too, man, is it comes down to ego. Mm-hmm. And I, just like anyone else, I have an ego. Like, shoot, like I was telling you, it's like, man, I've moved to Jersey City. This is freaking hard. Like, I should be in Manhattan. But there are trade-offs, and you have to kind of put your ego aside sometimes to be able to make the right decision. Mm-hmm. And so being aware of the cognitive biases that affect us all, right? Mm-hmm. Whether it be confirmation bias, whether it be anchoring, being aware helps to defend them, but you can never really get away from them. Mm-hmm. So being aware of the fact that I'm going to be wrong a lot helps me to admit when I am. Mm-hmm. And to make sure that, through either journaling or repetition, I'm not making those same mistakes more than once, right? And so if you can really limit the number of times you make the same mistake, then you're going to be much better off down the road, because you're basically creating a better filter for yourself, right? Mm-hmm. And that's why I have mental models and frameworks that I really stick to, mm-hmm. right? And you can think about it as a circle of competence, right? Mm-hmm. I'm not going to look at a turnaround story. A stock can be trading at a 5 PE, right? And maybe, its comps are trading at 12 times. I am not going to go invest in that company if it's a turnaround story, because for me, the probability of being right is so low compared to if I can find a monopoly or a structural oligopoly or an asset-like compounder, or just a company with a legacy and reinvestment mode. I'm going to stick to those names and not this turnaround
a winner
story,
that's already winning,
Why would I, like, this is something else too. This go back to sports, right? Yeah. Why do I love Alabama football? Because these guys have a process and they have a recipe for winning and success, and they're the best. Mm-hmm. If I'm going to go and bet on a game, probably going to bet on Alabama versus Nicholls State. Yeah. Because Alabama's a winner, and they're the best in their industry, in their conference, right? Right. So that's the way that I think about it. It's, once again, it's trying to find companies that are in unfair fights, mm-hmm. right? And if you can find that unfair fight, throw your money at it and just and let them win, right? And you don't interrupt. And that's another thing too. Just look for win rates, right? Mm-hmm. Don't interrupt that winning culture at a company once you've given your hard-earned dollars to them.
Mm-hmm. That's awesome. No, I think about the same way, and I try to approach every mistake I make, whether it's trading, because we all make them, as a learning moment. And as you said, just try to journal, look at the setup. What did it look like before? Was there something I missed in the chart and the fundamentals, all of that, and just try to do a little bit better next time. And eventually over time, because this is something I want to be doing for decades. I'll get better over time, absolutely, if I just keep working at it. So I 100% agree.
You can't admit to yourself that you're going to be wrong a lot. You're going to be out of this game really quickly. Yeah, because you're going to be wrong a lot, and if you can't, if you have cognitive dissonance around that, you're going to struggle really badly. And like, I wish I was better with my journaling. Yeah, I'm sure that it'll come with more experience, mm-hmm. and making sure that I'm very disciplined about it, because I'm a crazy disciplined person, but sometimes when it comes to journaling, I'm like going too fast and I forget. But when I do journal and I do go back to those charts and I've marked up my chart and like this was my entry point, this is what I was thinking at the time,
Hmm.
right? That then allows you to then, for the next time that this situation comes around, once again, you're minimizing your error rates.
Yeah.
You can be like, well, hold on, there was this corollary back then. Like, is this the same setup? Could I be wrong?
Right.
And it's the error of, commission or of omission rather. It's hard to deal with. But I think what's the most important thing is that even though you're going to miss some names sometimes, whether it be of omission or commission, when you do invest and you do, put your money behind an idea, that's really what matters, that you're right then, right?
Hmm.
And I have so many examples of just opportunities I've either passed up or gotten out too early, because I haven't either followed my rules or because I've, hadn't journaled and
Hmm.
I missed the setup before, right? All that I can do is hopefully, like you said, do better the next time, but really stick to that journaling practice because journaling is it's a powerful tool, right?
Right.
That I think if more people did, you would really improve your outcomes.
Absolutely. And going back to your process, what really stuck out to me when you were talking about interpreting a new earnings call or something like that is that key debate question. What is the key thing that all the analysts are focused on? Like I think with pins, the key debate was the lowering monthly users. Is that right? Am I
Yeah,
right
the
there?
US domestic
Yeah,
users.
yeah.
Yep.
So talk me through how you try to identify that key debate and how institutions might interpret that, and then that completely changes their models, and thus the kind of the trajectory of the stock, because obviously they've got a lot of money, they're moving that around. They might reallocate somewhere else if they see that this company is kind of losing that key debate and losing that really vital piece of the business.
Yeah. So it's obviously different for every company, right?
Yeah.
But if I was to generalize it, so obviously, I'm reading the transcript, and if a if the analysts are asking the same question like over and over again,
Yeah.
maybe it's in a different way around around this like where it's with pins like this U.S. domestic users,
Right.
then that's hitting you right in the face, right? Like
Hmm.
that's what everyone cares about. But I mentioned to you before too, like what I'm doing before I'm even going to the transcripts is I'm looking at the company's full financial model, including the KPIs.
Right.
What I'm doing is I'm running, and I think I mentioned regression analyses when it comes to kind of the other non-critical drivers.
Hmm.
But for the critical factors, the only way that I can know that it's truly a critical factor is by running regressions against, for the KPIs, either against revenue,
Yeah.
but also against like price performance, right?
Hmm.
And so that then like there's no hiding from the data
Right.
that this KPI or this metric is what's driving the stock, right?
Hmm.
And so I'm going into these earnings calls already having a pretty good idea of what matters,
Right.
right?
Right.
And what's interesting there is that if I like through the data, if I can see what matters and it's not what's being focused on by analysts, it's either one of two things. Either they're kind of missing the forest for the trees,
Hmm.
or there's been a paradigm shift and something within the company is changing,
Has
right?
changed. Yeah.
So that's also very informative too, because that then is kind of like, your spidey sense should be going off. Well, maybe I missed something, right?
Right.
And so by me doing this, pre-work, by me
Hmm.
looking at the KPIs and financials before I even go to the earnings calls, I already have an idea of what that key debate is,
Yeah.
right? And then as I'm going through and I'm reading both what management is focusing on and if they're trying to like really, identify something and call it out in the earnings transcript, and if
Hmm.
the analysts are talking about it, then to me it's like it's clear as day. And so we can
Hmm.
go to an example, right? Like fast, right?
Hmm.
Fastly, the key debates around compute at edge. When is that going to come out? When are there going to be customers really utilizing use cases around it?
Hmm.
Management talks about it. They bring it up. They focus on it. And then the analysts focus on it.
Yeah.
For Fastly, again, Signal Sciences, right? That acquisition. Management talks about it. Analysts talk about it. So for me, like it's another like critical factor around the integration
Right.
around Signal Sciences. And so that's kind of the the main way that I'm figuring out what that key debate is.
Makes
It's
sense.
what does the data tell me? What are the numbers tell me that, they're objective, right? There's no subjectivity there.
Mm-hmm.
And then what is really the focus by management and the analysts? And is this like a recurring type of theme, right?
Mm-hmm.
And then, after the fact, you can also just once again do your channel checks. Like I'm going to be calling the sell side analysts, calling the buy side guys, and just being like, hey, like what are you seeing here? Like what is
Mm-hmm.
what is important to you, right?
Mm-hmm.
And so all of it's really creating this mosaic, right? It's creating this picture of the company, and that'll then tell me, yeah, like what really matters.
Mm-hmm.
And then from there, once again, like I told you, it's spending like the majority of my time, think like Pareto's principle. The majority of my time will be focused on figuring out those key things, in
Mm-hmm.
my opinion.
Mm-hmm. Perfect. And I want to now focus more on kind of the active management part of the kind of CANSLIM trading that you do, and go through some examples and hear your thoughts of some stocks and how you've interpreted both the fundamental side of things as well as price action. And I know you're really focused on semiconductors, so maybe we can start with NVIDIA, KLIC, one of those. And feel free to share your screen and we can talk about that.
Awesome. All right, so I have Snowflake pulled up just because I'm incredibly bullish Snowflake.
Let's talk about this one then, because this is one I'm also watching pretty closely. I'd love to
Sure.
hear your
So
take.
yeah, so the reason why I love Snowflake is because it's optically expensive.
Mm-hmm.
But if you do your homework and you think about more of a longer term view,
Mm-hmm.
I think it's still very cheap. And
Mm-hmm.
I think at an 86 billion-dollar market cap here, we're going to look back in 5 or 10 years and just wonder how the heck this wasn't being bought hand over fist,
Mm-hmm.
right? And so just really quickly, right? If Snowflake is trading at, I think it's 55 or 60 times next 12 month sales,
Mm-hmm.
right? But you look here in the bottom left hand corner, and they're doubling year over year,
Right.
every single quarter,
Right.
right? So let's say that slows down to, I don't know, 80% year over year for the next 12 months, right? If you think about the next 12-month sales multiple as a percentage of what the growth rate's going to be, you're cutting that multiple. Like that's what 0.67 times, like it's 2/3.
Right.
That's a lot cheaper than a stock that's trading at, say, 20 times sales, but only growing at 10%.
Right.
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 So I'm going to take, just based off of like a very simple valuation framework, I'm going to take Snowflake forever and a day over that company.
Mm-hmm.
Another thing too is that, and this kind of comes back from my semiconductor research, Applied Materials had this slide deck in there. I think it was their latest investor presentation, basically around the growth of data, right?
Mm-hmm.
And something that human beings just can't conceptualize is exponential growth.
Mm-hmm.
Data is growing exponentially,
Yep.
right? And so what that means basically is that it's asymptotic, right? It's going to basically be growing up to a limit where it's almost not quantifiable for humans. We think very linearly.
Mm-hmm.
And so if you then crosswalk that to Snowflake, well, Snowflake is, if I was to put it very simply, it's a data warehouse, but really what's happening too in that data warehouse, if you will, is not only analysis, but they're now doing computation too,
Mm-hmm.
right? And then you talk about network effects, the fact that you can share data across customers, that then means that it truly is a network effect of, every additional user enhances the value of the platform for the next user, right?
Right.
So that's kind of a very simple framework for Snowflake. And if you think about where we're at with data today, and if I was to take a very simple mental model of, okay, well, Snowflake has $86 billion market cap. There's, X, terabytes of data that's being created every year. And then I compare that to what that's going to look like in 5 or 10 years, then you can roughly extrapolate out what that market cap should look like, right?
Right.
So that's just kind of like a very simple framework.
Mm-hmm.
And now if we go to the chart, like I wouldn't say, and you correct me if I'm wrong, like this is not maybe like a typical CANSLIM looking like consolidation pattern here where there's like an obvious like cup and handle.
Mm-hmm.
But if I was to look at to zoom out a little bit and just look at
Hmm.
on this weekly how beautiful and symmetric this really
Yeah.
does look like a kind of a bigger cup does look
Hmm.
like that's pretty attractive to me. And what I like is that it's not really getting ahead of itself either,
Yeah.
right? It's just been slowly chugging higher,
Hmm.
right? And so maybe it's not a typical CANSLIM chart. Would love to hear your views on it,
Hmm.
but it's something to me that looks like there's a lot of digestion happening as buyers are coming in and accumulating a lot more stock than there are sellers.
Right. No, no, I agree. And I don't know if you've read Kathy Donnelly's book, The Lifecycle Trade, but they basically went back into history and analyzed all these recent IPOs and basically try to determine different rules, different phases that they go through. And this stock had a little bit of an IPO advance phase right here, where I mean, it shot the
Yep.
right side of the IPO run. And now it's entered the longer term institutional due diligence phase where people, where big institutions are doing what all the things you talked about, looking at the critical
Right.
factors, basically determining whether this is a worthy investment, how much capital should we invest in the stock, what's its future. And now it's moving out the right hand side. I actually do have a position in the stock at this moment, as well as PLTR. I bought that on the earnings gap up, which is similar, which I want to hear your thoughts on as well. But yeah, this looks very constructive above all the key moving averages. RS line has been an uptrend since this
Yep.
little undercut of this low. So looking in terms of supply and demand, this is definitely pretty interesting. I really like how it closed this previous week. And
Yep.
if you look at a daily chart, I don't know if you want to move on over to that to get a little
Yep.
bit more um, focus, but it's been riding the shorter term moving averages. I don't know what your purple line is
Beautifully.
here. Yeah, but it's been just in a nice uptrend, and I see you've got an alert line there at 300, and it's been increasing on higher than average volume, and the pullbacks for the most part are on below average. So yeah,
Yep.
this is one I'm really focused on. I like the stocks just coming out of this pattern where they've gone through their longer term due diligence phase, and then are starting to move up the right hand side. We saw so many of last year's winners: Zoom, Peloton, Fiverr, um, Neo. All of them were moving out the right hand side, and that's when they really took off and started
Yep.
getting accumulated. And of course, going over the fund ownership, nice increasing trend. A bunch of
Yep.
the big funds, the best funds with the greatest track records are in the stock. And like you said, the revenue growth on this company is outstanding. And I also have a little bit of a data machine learning background, and it's going to be so integral to everything that happens. All this data is going to change everything about how we live. So no,
Oh
no,
yeah.
for me, this is definitely a focus of mine, as well as PLTR, which yeah, but any other thoughts on Snow before we move on to
Yeah,
that stock?
I'll say that what I am trying to work on. So, I do believe that, especially with CANSLIM, really any methodology, right? Any
Yeah,
sort of framework that you have for trading, it takes time for you to really work at practice.
yeah,
And so, like for me, right, I've really been employing CANSLIM for I don't know, let's call it like a couple years, right?
mm-hmm,
And what I was trying to focus on at first was the very like traditional, I'm going to buy at the pivot of a cup
yeah,
and handle or a cup or consolidation. And that's what I was sticking to, right?
mm-hmm,
Because I was new. I couldn't, I didn't know how else to utilize the framework. But what I'm trying to do now is like we were just talking about, is start buying names as they're building the right side of these bases,
exactly,
right?
yeah,
And
yeah,
that's Snowflake. It looks obvious to me, right?
mm-hmm,
And so I own Snowflake as well in my personal portfolio, both in my long term and the more actively traded one, because the long term view we talked about, and then shorter term, like we said, it looks like it's building the right side of this base, and volume and the price action looks really positive. And I'll just add one last thing for Snowflake. Frank
mm-hmm,
Slootman, I mean, he's just a serial CEO, right? This guy's retired, probably on
mm-hmm,
his yacht somewhere. And after, I think he brought two companies public, and he gets a call from Snowflake. This guy has made all the money in the world. He doesn't have to do anything else. But yet he comes back to be the CEO of this company.
mm-hmm.
I don't think there's any way this guy does this if he doesn't truly believe that this company has a long, long runway. And I think they do also. So, yeah, that's Snowflake, a name that I love because it looks expensive,
Mm-hmm.
but I don't think it really is once you really kind of go a couple of years out and see what they're going to look like from there. So yeah, like we can move on to another stock. Maybe, yeah, let's do a semiconductor stock. So
Let's do it.
and maybe we can rip through these ones too,
Yeah,
because there are a
sure.
couple I think that are really, really interesting. So KLIC Sofa is a company that I wrote about, man, I think this was like in April or it was a couple months ago, right? Earlier in the year.
Mm-hmm.
So this is a right tail strategy that is not the typical monopoly or oligopoly, even though they are, but it's in a really kind of, I'll call it a lower margin industry. But what this really is what Yen Liao calls a secular within cyclical right tail strategy, meaning there's some sort of supply shock
Mm-hmm.
accompanied by a faster, really a demand shock, accompanied by a slower response on the supply side.
Mm-hmm.
And that's really what's happened in, let's just call it the chip industry in general.
Mm-hmm.
And there were two different really big things that happened really going into last year and into this year. One is in 2019, there was a semiconductor bear market, right?
Mm-hmm.
And so we were in 2020, we were really coming out of this bear market. But with COVID hitting, you had industry, not industry participants in the semiconductor side, but their customers, they're delaying orders, they're stopping orders. So there was this kind of halt, but then everyone's like, holy crap, we have this digital transformation coming. We have to order more
Right.
chips. And so you had this, all of a sudden, this spike in demand where supply had stopped because all the fabs had not stop production, but they were mostly shut down because of COVID.
Yeah. Yeah.
So now we have this massive backlog, right? And I think everyone's been following the semiconductor space. We started off with having like a 12-week lead time. I think the average lead time for a chip is like 7 to 9 weeks, somewhere around there. It was at 12 weeks, and then 16 weeks was kind of like that line of demarcation where you get some of a concern for double ordering.
Yeah.
Now we're at 20 weeks as of the end of July. So you have this setup where we have a very favorable for the chip companies supply and demand dynamic, right?
Mm-hmm.
Where there's a complete imbalance. KLIC Sofa is, as you guys can see, a relatively small cap semiconductor company. And what they are is they are the leader in what's called advanced packaging, or really wire bonding, which is not advanced packaging, but it's packaging equipment.
Mm-hmm.
Wire bonding is what's used as the interconnect process for about 80% of all interconnects. So every chip that's made, about 80% of them are done using wire bonding, and really
Mm-hmm.
all of like the lagging edge nodes use wire bonding for the most part. And KLIC Sofa, they have basically 60% market share of
Mm-hmm.
that wire bonding equipment. So long story short, this goes actually back to the price implied expectations. Based off of the work that I was doing, even like street consensus, like the stock should have been in the low 70s back when it was in like the $48 range. So I think, let me see. Yeah. So right here in the May time period,
Mm-hmm.
see how it's starting to build the right side of this base.
Yeah.
And then this volume was just insane
Mm-hmm.
on that initial breakout.
Yeah.
So when it was at 48 or around there, I was like, this name should be at 70, the low $70 range, right?
Mm-hmm.
So that's when I built my fundamental like base case and I issued a report. Let's go with the CANSLIM type of process though.
Mm-hmm.
If you look at the EPS growth over here, it's really kind of mind-numbing. And what's even crazier though is that we're at 140% year-over-year growth in September, and that accelerated.
Yeah.
Like,
Yeah.
the company did 600% last quarter. Same thing though on the sales side, right? And so it's really checking those traditional CANSLIM fundamental factors. Then you look at the composite rating of a 97, the
Mm-hmm.
accumulation distribution rating of a B. Like this thing, it looks beautiful from a lot of these different perspectives.
Mm-hmm.
And then we come to this, this cup that it built here, and it was not very symmetrical, so not a great looking cup, I don't think, but it had this really explosive growth out of the earnings print,
Mm-hmm.
or just what was this? There's a catalyst here.
Yeah.
I forget what this catalyst was, but something happened around this time period where it had a massive breakout. Oh, this must have been they issued revised guidance. I think that's what happened here, right? Then the stock just pulled back dramatically until we had their latest earnings print, which was just, it blew even my expectations out of the water, right? Like I think that I had this year's revenue at like 1.2 billion, and they came out and they revised up to 1.4 or 1.5 around there. And so that actually, this is a good part for me to just say, people need to just, if we were to very simply talk about what drives stock prices, it's very, very simple. It is changes in the expectations of future cash flow. That's what it is, right? And so if those earnings or cash flow guidance figures are revised higher, that's going to drive the stock price higher, right? And so if we want to then dive into the latest earnings by going to the daily, and this is something that, I think it first really hit me when you were talking to Jim Ropel, was this, the move on earnings, this gap up on explosive volume. I mean, so they report in the morning of really August 5th, so that you're going to see the gap today here on 200% volume on this gap up. And then this thing just ran. This ran right up to 20%. And something I've tried to do a better job of, and I've done really well the past 2 times I've been invested in a stock that's done this, right? Has been KLIC and SOFA and AMD.
Yeah.
As soon as I get to my about 20% return from the pivot, I'm taking some chips off the table.
So right at this green zone here, which Market Smith
right
draws
here in
in.
this green zone here. And so once we closed on the 10th in this 20% return day. It was in a red day, but I took about like half my chips off the table for KLIC and SOFA, right? And this is a name that like I'm telling everybody that I'm very bullish on.
Right.
And so people are like, well, why are you selling? Well, I'm not getting out of the name. What I'm doing is I'm understanding that there's a very important difference between realized and unrealized returns, right? And so that's what I'm doing. I'm trying to optimize my overall returns. And so what should happen here is, this moving average is 21 week. What should happen is the stock should revisit this 21, or maybe even like the 50 day, right? It should revisit the 50 day or the 21 day moving average. And once it revisits there and it touches there, then I'm going to be pretty comfortable with getting back and then adding more size back to the name, right? What's your view on kind of these pullbacks here once we've gotten like 20% or 25%, unless it's, it goes up that fast and say, what's it, like a 3-week rule that Bill has?
Yeah.
Then you hold on to it for 8 weeks.
Yeah. So that's with, it's called the 8-week hold rule. And I believe it's when a stock in 3 weeks goes up 25% from a proper pivot. So this, I'm not sure if it met. I think it does, because it has an explosive move up after earnings. But with respect to taking profits, I think it's always a good thing. As you said, trading around a position can really maximize returns, and understanding when a stock has gotten a little bit extended and might revisit the prior pivot 63.69 or the key moving average 21.50. And that also gives you a little bit of, you kind of have a sense of what should the stock be doing? What does natural action look like? Because what happened on this earnings gap up is something, as you said, the catalyst, the guidance was raised, and so people had to update their models. The big institutions increased their position or what have you, and then we have some short-term holders like yourself, which took some off the table after they've gotten a nice gain in just a few days. So the supply and demand has to once again balance, and once the institutions add back enough and the supply and demand shifts back towards the buyers being in control, that's when the stock can continue on and start to trend. And that might happen at a pullback at the 21 or at this pivot. We don't know. But yeah, that's how I'm kind of interpreting what's going on behind the scenes when it comes to this price action. But I'd love to hear your thoughts too on how you analyze price action.
Yeah, no, that's exactly right. And we were talking about extended. right here, today, once it got up to that 20% move, it's 25% above their 50-day. Like
Exactly. Yeah.
I'm going to be pretty comfortable in terms of making the bet that it's
Yeah.
going to come back, down to reality at some point, right? So like that's why I was comfortable making that trade around
Yeah.
taking some of my gains.
Yeah.
And no, but I completely agree. Like so, I've heard different, conflicting ideas around volume, but to me, volume is very important.
Hmm.
If this move happened here on very light volume, it's not telling me much, right? I'm not
Hmm.
having a lot of conviction there. But if on 3 or 4 straight days, right, we're having some pretty substantial moves higher, then I'm going to get pretty comfortable around the fact that it is the institutions coming in and buying this name
Right.
once their models have been revised, et cetera, et cetera. So
Hmm.
look at it a very similar way. And so if we want to move on to like AMD, for instance, which just happened recently
Yeah. Let's do
too,
it.
it's a very similar type of move for me. So I was actually buying a lot right around here. Yeah, it was right before, and I mean I would have actually had more conviction right here on the day that we had earnings. I already had a position,
Hmm.
but I'd been doing a lot of homework. I was loving the setup here with the cup with handle.
Hmm.
And so I was buying some here as it was coming back up, trying once again how I talked about what I'm trying to buy names that are coming up the right side of the base. But
Yeah.
here I could see, like, we see how this volume is so light here in the handle.
Right.
Like, I love that.
Hmm.
And so I'm like, okay, like this, I'm trying to understand, like, this is a very typical, like, cup with handle setup. Like, this is exactly what Bill talks about. And so I'm buying a little bit more here. And then once we had earnings, I mean, this thing just shot up through the freaking roof here, right?
Hmm.
On what, 250% volume and right here into the pivot.
Yeah.
And then it just runs.
Yeah.
And once again, you talk about the analysts and the funds revising their models. Well, this happens right up into this day, right? We have this, I mean, it's not a blow off top,
Yeah.
but this is on 330% volume and it closed, and where it closes is important to me. It
Hmm.
closed in the middle of its range here,
Hmm.
right? So that almost told me that all the buyers have come in, but there's not a lot left right now,
Yeah.
right? And so at this point too, we're 35% above the 50-day. Okay, it's time to take some profit off the table.
Yeah.
But and so I do it the next day, right? Because I always wait for the close. And
Hmm.
maybe that's right, maybe it's not, I don't know. But that's just what I've been doing so far. And so in this next day here, the stock is down. And it's really hard to sell on days where the stock is down because you're like, you know what? No, I want to wait for it to come back a little bit. But it's, I think, having that discipline to just, you have a certain strategy in place,
Yeah. Be
execute on it.
consistent. Yeah.
And Jason, I mentioned Jason to you. He said to me too, he's like, listen, man, like you're gonna feel a lot better. And this is a really helpful framework for me. Are you gonna feel better taking some chips off the table if the name comes down here, right? You have less pain, or if it goes, or will you feel better like you maintain that full position and it like goes up or it comes down?
Hmm.
And so for me, I'm like, I'd rather have some chips off the table. I'd be okay if it kept going higher,
Hmm.
but I'd feel a lot better with some chips off and it comes down, right?
Yeah.
And so that's exactly what happened here. And I mean, that's just, yeah, that's a beautiful move to me. And now it's interesting because semis in general have been somewhat rolling over, and I think the
Hmm.
SMH is in somewhat of an inflection point right now. But AMD's been showing some more strength here, so maybe bottoming even,
Yeah.
and trying to maybe consolidate a little bit before it resumes that leg higher. And
Yeah.
so I'm kind of going to wait to see. And what I'll do is kind of go out to the weekly,
Hmm.
and I'll start to see if we can start getting a little bit tight right within here. If we can get a couple tight weeks, then
Yeah.
that'll give me some comfort, right, in getting back and adding back to my position. And once again, we talk about the EPS and the sales growth. I
Wow.
mean,
Let me look at that.
yeah, you can't wish for much better than that, right? That's, oh my God. You have the 36% return on equity. This is just really a home run name, and you have, if you want to get into more of the fundamentals, you have Lisa Su, who is one of the biggest rock star CEOs out there.
Yeah.
She's really, the turnaround job that she's done, second to none. You think about Satya Nadella at Microsoft, Lisa Su is just right up there. And then I talk about earnings revisions and sales revisions. I mean, look, right here.
Yep.
You know,
Yep.
estimates are coming up. So AMD is another great example. Then you have NVIDIA, you know, a
Could
couple in,
I actually have something I'd like to point out
go
on
back to
the
AMD. Yeah.
yeah. Sorry, could you go back to a daily as well? Because moving up the
Yeah.
right hand side, this was acting super constructive, and you mentioned the dry up in volume in the handle, but I think the actual first telltale sign, and Ray pointed this out to me, is a super tight action right above the 50-day up the right side.
Okay.
On
Wow.
on
Yep.
look at no volume here. This is super
Jeez.
tight.
Yeah.
And then you kind of have a textbook explosion up in volume right here. So this was a nice tell here, and I didn't trade it
That's
back
interesting.
here.
Wow.
Yeah, but this was acting super constructive, and like you said, this volume really just took off. And I sold half here on this day. Tried to add back half on this oops reversal. I actually took off my position end of day because it closed below the prior day's low, just managing risk.
Right.
But I did add back actually on this most recent Friday. So we'll see how it acts here. But the stop on that additional half that I added back is just that low of the day. So we'll see if this actually starts to turn around, moves back towards the high, or if it needs a little bit longer and forms another tight week maybe. But yeah,
Yeah.
definitely super constructive action. And this pullback was a little bit harder than I was expecting. But like you said, it gives you a little bit of peace of mind to take some off the table when you've already got a nice gain in just a few days. Yeah, just it's a mindset thing, I think.
Yeah. No, and I think it's really important is that sometimes you just have to, it's all like with your position sizing, I think a lot of it has to be what is going to make you or allow you to make the best decisions,
Yeah,
right?
yeah, right.
If you're, man, if you have like 30% in a name, like I could never imagine holding like a Tesla like at 30% sometimes, because unless it's in like a 2020 bull market,
Hmm.
I mean, the volatility of that thing, I personally wouldn't be able to make the right decisions around it, right? So I think that position sizing and then taking some chips off the table is really important sometimes, just to allow you to keep making the optimal decisions. And you know,
Absolutely.
another thing too, just on AMD is, you know, this thing did nothing
Hmm.
for God since September of last year. Meanwhile, you have 128% EPS growth, 63%, 189.
Yeah.
And so all that's doing is it's growing more and more into its valuation. So like this move now, it's ready, right?
Hmm.
To me, that's what it says. And
Hmm.
it's, you know, we had this, you know, double bottom here, and nothing happened when it came out of it,
Hmm.
right? And so and I wonder what the volume was like here. Yeah, a little bit lower. You know, we can go to the week, the daily, but yeah, for me, it's, you know, it's a lot of different things. Once again, a mosaic
Hmm.
of different data points that I'm like, listen, this AMD is ready. On top of the fact that I'm just a big believer in the long term, secular positioning of AMD.
Yeah.
If we want, we can go to like NVIDIA as another example.
Yeah, and after that one, maybe SITM. I don't know if you've done a deep dive on that, but that's one that had a huge earnings gap up. And like you said, some of them have been kind of rolling over, but SITM is one that's held up pretty well. So, but for
Let's do S because another or STM, right?
yeah, SITM, yeah,
SITM, right? Got
yeah,
it. Another one we can do too, just because we've been doing a lot of semis, is I'll do another. Holy yeah, look at that guy.
yeah.
I actually don't follow this name too closely.
Hmm.
So you want to go to the daily?
Yeah, sure.
I mean,
Is this?
this is beautiful. Look at this.
Yeah,
Yeah, this is another one. I mean, look at that move.
I know.
Like this is another interesting point. I think that maybe it was before we were recording, but investing should not be complicated. It should be
Hmm.
hard. It's very hard, but don't complicate it, right?
Hmm.
Like this is an example where you have 3 quarters here straight of
Hmm.
200% plus EPS growth, 99 composite. You have A's across the board, and then you have this breakout move here.
Hmm.
Like that's I mean that's a beautiful stock right there.
Yeah. And it was when I was watching. I didn't play the earnings gap up. But yeah, we'll see how it acts. But like I noticed a few others like LRCX like completely rolled over
Yep.
last week. So it's interesting the relative strength
Yeah.
shown
So
by a
like
few of these.
LRC, both LRCX. Look at this.
Yeah.
This is coming right back to the bottom of its channel,
Right.
right? And yeah, that rollover was really brutal. And then same thing here with AMAT with applied materials,
Right.
the same chart almost, right?
Yeah.
And so it's interesting because these guys, you know, the leaders in their industries, but to see like the lack of relative strength is like to me a little bit concerning, right?
Yeah. Yeah. Absolutely.
So a non-semiconductor name, Zoom Info.
Mm-hmm.
Zoom Info is a stock that I've been really kind of all over. And let's just zoom out a little bit. Since its IPO, it's done nothing.
Mm-hmm.
But like with AMD, right? You have 75%, 120%. You have triple digit EPS growth
Mm-hmm.
with plus 50% revenue growth. So come here to the daily so we can see it. I think this was the day, the day right after EPS. This was the problem here. So we had a gap up, right? A big gap up on earnings, on really strong volume, right? Look at the volume, 1,000% volume. I think today, though, this was a day that the NASDAQ got smoked. And so I think it came back down with everything else. But then you had this recovery the next day. And that for me was really positive. When I saw that recovery back to this pivot area, I felt very comfortable that this was very constructive. And so, I mean, I was already in the name, right? So I was in the name, I think I was like around here in the 50s because I thought that it was building back up here. So I was here like right in the 50s. You see the really low volume. Maybe it was like right around here. What is this? Like, yeah, mid-July. Mid-July is when I was in it. So you have this really light volume here.
Right.
Wasn't going anywhere. I almost got shaken out right here. But it never crossed through that 50 or that 100 day. So I was still in the name. And then it started building back up, right? And on this move back higher, once it closed back in the pivot range, I felt really constructive. And then it closed again last week, right here in the pivot area. So I'm very positive on the name because it keeps closing within this pivot area. I think that after this last earnings, it could be that one earnings report that finally gets the breakout of where it's been trading, you know?
Yeah, and I've tried this one a couple times. It's been a really tough one to actively
Yeah.
trade. Just look at this daily chart. It's super choppy, and like you
Yep.
said, it had gone nowhere for the longest time, and people were trying to trade it, and it just shook them out. You can see it tried to break out of this cup, then just had this
Yep.
choppy and started this most recent base. But it looks a lot better if you go back to the weekly chart,
Oh,
especially
yeah.
the recent action.
Yep.
Because instead of that earnings gap up, which wasn't super high volume, it closed on a daily chart basically at the low of the day, which isn't very constructive. But by the end of the week, it recovered really nicely and closed right at the top of the range. And then last week, pretty tight inside week, right at the pivot, and with once again a really good closing range. So yeah, this
Right.
could be the start of a breakout through a breakout move through this, and yeah, looks pretty constructive, and a lot, as I said, a lot better on the weekly than it does on the daily. It's just a mess on the
Yeah.
daily.
I know. And that's what I'm waiting for, right? It's, you know, I'm not going to really go into size until I can see, like, if we can break out of here,
Yeah,
that's going to be a lot more constructive for me.
yeah. And can I ask you about how you handle position sizing and starter positions, and what makes you add to a position? Could you talk about your process there?
Yeah, definitely. So first with like, let's start with maybe the number of holdings that I'll have
Mm-hmm.
in my personal portfolio. So I think for me, like some people say 10, like I'm really 8 is really optimal for me, I think. You
Mm-hmm.
know, and I'm comfortable having anywhere between 6 to 8. And so if you just like divide that by 100, like what does that imply? Like 12.5% if I'm at 8 names, 16% if I'm at 6 names.
Yeah.
So it like we'll be around there, right? Just
Mm-hmm.
on a very steady state basis. But where my adjustments will come in is really a couple things. One is this a stock that I won through my deep dives, have
Mm-hmm.
high conviction in,
Mm-hmm.
right? And this is once again going back to my IRRs and how I'm thinking about skew. And then also has the stock been a winner,
Mm-hmm.
right? Like if you look at your portfolio, you're either your loser or your lowest return stock should pretty much be your lowest weighted stock, right?
Mm-hmm.
And vice versa, your your best performers should pretty much be your highest weighting stock. And so I'll tweak and I'll tinker with the weights really based off of my conviction and skew. But a lot of it too, once again, comes down to, you can think about it through the CANSLIM, framework. It's, if this name is exploding out of this, long consolidation pattern on extremely high volumes, then, and it's a stock where I've seen it do it before. Like, that's also important, right? Like with Zoom Info, that's hard. Like, look at this thing. It hasn't treated you well if that's the way that you've traded it.
Yeah.
But if before, it's consolidated, broke out, consolidated, broke out, then I'm going to be a lot more comfortable having a higher sizing on that front, right? So then when it comes to like building into a position, right, growing into it, I'm still working on it myself. What I got from Bill is, pyramiding, right? So, basically to simplify, if I have a certain weighting in mind, right, I'll buy 50% of that position right off the bat. And if you're not willing to put at least like 5% or 10% of your capital into a position, then you don't have enough conviction. I truly believe that. So 50% of my kind of target weight, I'll do right off the bat. And then ideally, right, if it's I'm buying in a pivot here, it's the 2%, then the 2% I'll fill in the rest of that 25%. If it's coming up the right hand side of its base, I'll look for just more constructive type of moves, whether it be a nice day on high volume, whatever it may be, is when I'll keep adding that 25%. But I'm really not horsing around. I'm building into it pretty quickly and trying to get that exposure. And then when it comes to the trimming and adding, a few things to kind of think about. One is if I have an underperformer and the stock is performing really well, I'll kind of shift weights that way, right? And so it's more just the street is telling you you're right? Like people say, price action changes sentiment. Well, yes and no, right? Your sentiment does not change just because of price action. Like you either have conviction or you don't. But what price action can do is really provide you with more confirmation, right? And so if the stock is breaking out and it's continuing to go higher, it's the street telling you that you're right? There's something there to your thesis. So I'll kind of shift some of my portfolio liquidity around that way. And then, we talked about really roughly, like, what is it like to kind of take some chips off the table? That's what I'll do with, with the 20% move, or even if it's just extended, right? Even if it hasn't gone, 20% that quickly, if it's really extended, I'll take some off. And then I'll think about, is it right to, and we can talk about the macro side of it too, but, if I'm going to, let's say I'm fully invested, I may not allocate those dollars elsewhere if it doesn't make sense, right? Like for me in my personal portfolio, I'm not running a relative return strategy, right? Like I don't have to be fully invested. It's okay to, be 70% invested, even if I think that, I should be 90% overall, right? So that's kind of the way that I think about, like, on the trimming side, is just make sure I'm realizing gains here and there. And then the adding side, yes, if the stock is performing well and my thesis is, playing out, then I'll just add to the name that way. But, and when it comes to, let's say, like a max position size, I think 25% is probably the max that I'd want it to go. Anything above that, I'd be I'd be probably too jittery around my decision making.
It's past the sleeping point. You want to sell, you want to have a position. Yeah, exactly. Yeah.
Exactly. So that's kind of the general way that I think about it. But I'll caveat too, right? Like we talk about like learning and growing. Like I still feel like, and I'm sure even like PMs have been doing this for years. I have so much to learn still, and still have to really find, my comfort points, right? But I think the only way to do that is through actually having skin in the game and doing it, and seeing, what doesn't let me sleep at night, what allows me to make the best decisions. And so all of like what we're talking about here is very much a work in progress for me.
Yeah. No, makes perfect sense. And I want to ask, because I always like to ask this question, because investors, traders all have kind of different answers to this. How do you personally define risk? And is it different with this style of investing versus the longer term investing side of your other portfolio, basically?
It's an awesome question and the right question to ask. So, and it's something that's like talked about so much on Twitter too.
Right.
So people say that volatility is not risk. For an individual investor, that is true. For if you're managing outside capital, volatility is forever and a day risk. Why? Drawdown risk.
Mm-hmm.
If your portfolio is down 25%,
Mm-hmm.
and you don't have perfect LP alignment, right? Like, so this is, let's say that you don't have a very special LP base that truly is aligned with you in terms of a long-term duration, right?
For people who don't know what LP alignment is, including myself, could you give a brief explanation of what LP alignment means?
Sure. So LP alignment in terms of your time horizon. So your LP base, your limited partners
Mm-hmm.
who invest their capital with you, right?
Mm-hmm.
If having LP alignment would be, your strategy is, let's say you have a 5 or 10 year time horizon, right?
Mm-hmm.
So you're willing to endure a 30% drawdown because you believe that over the long term you're going to be hitting a 25% to 20% IRR, right?
Right.
30% IRR.
Right.
You have LP alignment when your LPs are exactly with you, right?
Right.
When there's a 30% drawdown, they're not pulling capital. Maybe
Right.
they're adding capital, right? And they're trying to
Right.
juice their capital way to returns that way. That's LP alignment, right?
Gotcha.
So if you don't have that, right, and say you are targeting, 3 to 5 year returns and you're willing to endure 30% drawdowns, but your LPs are not, then you have drawdown risk, right?
Right.
And so volatility is risk
Mm-hmm.
because risk in and of itself is permanent loss of capital, right?
Mm-hmm.
Period, like end of story. So for an investor, volatility is not risk because that's not necessarily permanent loss of capital,
Mm-hmm.
right? Volatility, though, for managing outside money, it is risk because if you have drawdown risk, then you have if you have investors pulling out, one, that's permanent loss of capital for the fund.
Right.
But two, you're also then having to probably start liquidating names, which
Mm-hmm.
then creates a vicious cycle. So
Yep.
that's how I would think about risk, right?
Gotcha.
But let's maybe if we want to focus on on the personal side of things. So the way that I kind of define risk is what is the max loss that I'm willing to take on a name?
Mm-hmm.
And so this goes back to, I think Bill's framework, which is like 8%, right? And so if my quote unquote risk, which isn't the true definition of it, my downside is 8%, but I'm underwriting, say, let's say like a 7 times multiple on my money,
Mm-hmm.
then that's a really attractive risk return profile, right?
Mm-hmm.
And so I think that the true definition of risk is one thing, which is what we talked about with, volatility versus not volatility. But the other way to think about it too is more like downside versus upside,
Right.
which is, I think, a way to, kind of frame your trades.
Mm-hmm.
And the downside, quote unquote risk is really the first thing I'm always thinking about. And if I'm going to just cap that downside by having, whether it be a stop loss or really just like the max loss I'm willing to take on a trade from my
Right.
active portfolio, and that's it, right? And then, the return side of things really kind of takes care of itself.
Gotcha. No, that's a really awesome explanation. Thank you. And I meant to ask. I usually ask this way in the beginning, but for people who don't know, what is kind of your style, your time frame for your active management? Are you more on? I know you're not a day trader from what we said, and also the moving averages you use, but are you swing position? How would you kind of basically identify with a particular time frame?
Yeah. So yeah, no, definitely not a day trader. Having a full-time job, you really can't do that.
Yeah. Yeah.
No, so I would categorize myself as much more of as like an investor.
Right.
So for my active portfolio, and this is the desire, this is not
Mm-hmm.
how it always works out.
Mm-hmm.
I'm trying to target, let's say, like 12 to 15 months,
Mm-hmm.
and I think that that's reasonable given the duration of market leadership for a lot of
Right.
these growth stocks.
Right.
And so it's very much realizing that a lot of the time your leaders in one bull cycle are not going to be your leaders in the next cycle,
Mm-hmm.
right? And so just having that reality
Mm-hmm.
is kind of the way that I first kind of think about it.
Mm-hmm.
But yeah, I'm focusing more on this, on more of like for a growth cycle or for a bull market, what are my leaders? And so if I was to think about it, yeah, it's my time horizon shaking out to be around, yeah, like 12 to 15 months, ideally, maybe 9 to 15 months, depending on how
Mm-hmm.
things are working. But really what it comes down to, and this is, I think, an important nuance to discuss, is that you shouldn't base so selling, right?
Mm-hmm.
I think that investors and people and portfolio managers, we're not good at selling. You're joking yourself if you think that you are. We're probably great at buying, but not selling.
Mm-hmm.
And so when it comes to selling, when should you sell? One, you're wrong,
Mm-hmm.
right? And so for what we kind of do, we're talking about with this like max loss rule, we define wrong as the name coming back more than 8%, right?
Mm-hmm.
Because just our entry wasn't right.
Right.
But wrong could also be, I talk about the critical factors,
Yeah.
and your thesis is broken. That's you being wrong, which is, I'm expecting this KPI to grow by X%, and the company reports and it's not growing anywhere near there. Like, I'm wrong, and that's a core part of my thesis. I'm out, right?
Mm-hmm.
Some people say, and so another way, so that's a big one. You're
Mm-hmm.
wrong. You have to admit it. You're out.
Mm-hmm.
The second is you've been paid for your thesis.
Mm-hmm.
Now, that does not mean, I need to be very specific with this. This does not mean that when you invest in a stock, you underwrite the name and you underwrite, let's say, a 30% return over the next year, and you hit that 30%. That's not getting paid for your thesis. Because what you should be doing, and this is good examples, KLIC and SOFA, you need to be updating your thesis as you go along. And so Dennis Hong puts this perfectly. He goes, I'm a long-term investor, but the long term is the accumulation of a lot of short-term accountabilities,
Mm-hmm.
right? And so that short-term accountability has to be updated all the time. And so if I'm underwriting KLIC and SOFA to, let's say, a 50% CAGR over 2 years, just because I hit 100% return after year one doesn't mean that I'm out of the name, right? It's okay, well, here's where I'm at today. Is my thesis, once updated, does it still apply, right? And so if, an example would be, this is a good example, it's the law of large numbers, right?
Mm-hmm.
If a stock gets to a point where its market cap, let's say like, for Apple,
Mm-hmm.
we're at $2 trillion. And I mean, they've been proving everyone wrong, but if I'm at $2 trillion and for me to double, I'm gonna have to get to $4 trillion. Like, man, that's a hard hurdle, right?
Right.
But if I'm looking at, let's just zoom info, right? $25 billion. You have to add $25 billion to double. Well, that's different math, right? I can get a lot more comfortable with that.
Yeah.
So a way that, it's going to be hard for me to get paid for my thesis some more is just simply the law of large numbers. The
Mm-hmm.
company can age out of my book, right?
Mm-hmm.
And so those are the two ways that I would sell. What was the question again? Was, oh yeah, my time horizons. So that's the way that I think about it.
Mm-hmm.
It's, if I'm at, say, 12 months and I still haven't gotten fully paid for my thesis, and I'm still underwriting a 30% IRR, I'll stay in the name. If I'm at
Mm-hmm.
18 months, I'm still at 30% IRR, I'll stay in the name, right?
Mm-hmm.
But if, for instance, right, what would be a good example? I'll just talk about it conceptually. If I underwrite a 30% IRR and the name goes up 100%, and I'm like, this makes no sense. I can't rationalize this. I'm out. I'm okay doing that. Like
Right.
it could keep going vertical, right? Like, I mean, I don't know, like even like Tesla, right?
Yeah.
I wasn't invested in Tesla, but that thing just kept going higher and
Hmm.
higher and higher, and without any sort of fundamental change, right? And so that's multiple expansion. And so if I can't rationalize what the stock is doing, once again, it goes back to being able to sleep at night. I'm out of the name,
Hmm.
right? And so my time horizon, I can think about targets being that 12 to 18 month based off of just, true market leadership during bull cycles.
Right.
But it really gets a little bit more specific than that and objective than that being, what is my forward return looking like?
Hmm.
And am I right or wrong?
Right. No, that makes perfect sense. Um, and and yeah, I think the way I approach it, especially with a stock like Tesla, which obviously it just kept going and going, building bases and keep going. I'm just trying to kind of stay with that trend and let my position management rules, the moving averages, basically define whether I'm in or not. But there's so many different ways to approach it. I know people who sold Zoom at the top because it had already fulfilled their thesis, like their 5-10 year thesis in 9 months or whatever. So they just took the
Right.
profits. Right. That
But
makes sense.
what's so hard with that, man. And so like a part of me is I wish I could just do, what you do, right? Which is like you have your rules very much based off the technicals with some core fundamentals, right?
Right. Right.
And
Basically.
so that allows you to stay in a name like Tesla,
Hmm.
right? It's I'm and once again, this goes back to still learning,
Hmm.
right? And I think I'll say this too. I think that you can utilize different strategies.
Oh
There's
yeah, for
no
sure.
right, like, but I haven't developed that skill set yet.
Hmm.
I'll be honest. Like I'm not like some, know-it-all, like some like guru investor. Like I have so much to learn still. And I'm perfectly fine admitting that to a, channel with what's your audience? Like 30,000, 40,000 people now. Everyone, like, I don't know everything. I'm still
Yeah.
learning. And so like I want to get to a point though where I can trade around a name like that, right?
Right.
And I'll get there. But it really, in the way that I approach it is for what I'm doing currently in my current strategy, I want to make sure that I have that down pretty cold. And
Absolutely.
so from there, then I can then start adding on to that, right? And then developing more, if you want to think about like more business models, right?
Right. Right.
That's different verticals. So that's kind of what I'd say there, right? But what a lot of people do incorrectly, and I was trying to kind of caveat what I was saying about getting paid for the thesis is like they'll come up with a price target and they'll say like, oh yeah, my 5 year price target for Zoom is 400,
Hmm.
right? And it hits 400. That's not why you get out of the name because your underwriting could have been done like a year ago,
Right.
right? It's okay, we're at 400 today, but what does my forward CAGR look like?
Right.
And if I can't base off of the company's earnings power or free cash flow generation, if I can't get to like so, and I think the more important question that we should talk about is what does my return hurdle look like,
Hmm.
right? For me, the lowest IRR that I'm going to underwrite is 25%.
Hmm.
The lowest, right? I'm looking for 30% returns plus
Hmm.
annualized, so a
Hmm.
CAGR of 30%. And so people would ask, like, well, that's crazy. Like, how many stocks actually can do that over long time periods? And that's the point. Like, that's exactly the point. If we have, I think it's like what 2,500 stocks maybe that are greater than $1 billion market cap in the U.S. domestic, right?
Right. Right.
And maybe it's 3,000 plus greater than 500 million. And the reason why I'm kind of capping that is because liquidity is really important, right? If you're trading less than 400,000 shares a day, like, and you're meaningful, like, there's no like funds aren't going to be able to build a meaningful size with that, right?
Exactly.
And so that's an important. That's why I'm kind of framing it that way. So if we think about it that way, and if you think about what a right tail is, like a right tail is what like 2% of a total distribution, 2-3%, right? So then that's I don't know a couple hundred stocks that you
Hmm.
can possibly choose from. Then you start really whittling it down to more of those refined metrics that I look at. I mean, I'm looking at a universe of say 100 names,
Exactly.
right? So why wouldn't I have the absolute highest return threshold, right?
Hmm.
Like, what are we trying to do here? Like, what's the point? we're trying to earn the highest return on our dollars, right? Once again, the highest return for our time spent means the highest return on our dollars. So why would I underwrite anything else, right? And so that's really what it comes down to for me. It's, can I get to a 30% return plus from here? And it comes down to just understanding the earnings power. And I can kind of walk you through an example, understanding the earnings power and that return on invested capital. If I can't get to that 30% return, I'm out.
Makes perfect sense. And yeah, just going back to what you said about always being willing to learn things and refining. Absolutely. Everybody has something they can improve on. And this is why, for one reason why I do these interviews, because I get to pick Christopher's brain on this thing, and then learn from Jim Ropo about this. And the biggest thing, one of the big takeaways from this interview is that those critical factors that you talked about with the earnings calls, that's something I picked up, and I'm going to now apply to my process and see if it works. And just being open to learning new things, I think, is so important, and just being a better trader, investor over time. So I 100% agree.
I mean, that's why I subscribe to your channel. That's why I watch. I mean, I think maybe like every single video you put out, right? Because I learned so much. Like besides like Bill's book and talking to Jason, obviously he's a PM there, right? But aside from that, like your channel is the most informative source for me in terms of developing these skills. It's invaluable, right? And yeah, I think that the important point here is that if you are not, like, I would define the way that I think about learning is I'm obsessed about it. Like if I'm not learning something new, I'm really not like that. I'm not happy, right?
Right.
And so that's really the biggest key. And if you're not into learning, which once again, like investing is a competitive learning, it's a sport. It's competitive learning. If you don't truly love it, you're not going to be able to do this for the 30, 40, 50 years. It's just not possible, right? The beauty is that if you truly do love it, there is plenty for you to learn. Even after 30, 40, 50 years, you're not going to know it all, right? So like that's the beauty behind it all, man. And the critical factors point it's really a beautiful one. Back in the day, like when I was a younger analyst, I would think like, oh, I need to learn just everything about the company, and then return on time spent, what truly matters. If these 4 things drive 80% of the returns, I'm going to focus on those 4 things, right? Exactly. And so, yeah, man, like I'm constantly trying to refine those skills. And, I think that you forge iron through fire, and constantly testing your boundaries of comfort is so important. Like this, once again, I was touching on it before about the meta learning, but it's really more just me trying to get to peak performance at all times. What does that mean? That means that I need to be in peak physical, mental, spiritual health. I've started meditating every day, journaling every day. I go to the gym. I mean, with work, it's try to go at least 4 times a week. Sleep is critical. If you're not getting at least 7 hours of sleep a night, you're going to be cognitively behind everybody else. Nutrition, critical. And so people like, dude, like you're absolutely out of your mind. You're nuts. And maybe I am. But I'm trying to be at my very best every single day so that I can be the best investor that I can be, because that's what I love. It's what I care about the most.
Right.
And so I'm building my life around this, right? Maybe that's drastic. But if you think that's drastic and I'm doing it, maybe at the end of the day, I'll be in a better position investing wise than you would be. And that's perfectly fine. Like
that's whatever discipline somebody chooses to. Like if you want to be the best musician, it applies to that as well. Just your focus right now is to become the best investor, and you're dedicating 100%. Your life to it. Yeah. 100%,
and dedicate my entire life to it. Exactly. And I think that's really positive. Like I don't know if we've talked about it, but I'm from outside of Boston, and obviously I'm a Tom Brady obsessed with learning. I'm obsessed with Tom Brady. Shoot. And
I gotta end this interview now. Sorry about that.
I know. But it's not about Tom, right? But it's about his mentality.
Right, exactly.
And I remember this quote. I think it was in that like Facebook, like Tom versus Time. He says something along the lines of like, he's dedicating his life to this, and if you're not willing to do the same, then like you're just not gonna be able to hang with it. And that's the way that I think about it. And in investing, it's like, for me, I'm not competing with anybody else but myself.
Right.
Right. And my approach to life is, if I'm not better today than I was yesterday, then I'm doing something wrong. Right. I'm very much a believer in that 1% growth every single day. It could be something really small and minor, right? But over a year, if whoever's watching this, pull out a calculator and do 1.01 raised to the 365, the number is massive.
Yeah.
Massive. And there's
Right.
like that parable of, or the, I don't think it's a parable, but it's, I forget what it was, but it's something along the lines of, you know, like this farmer, like way back in, someone's gonna watch this and be like, "You idiot! This is what this is from." I'm drawing a blank on what it is, but basically, there was a farmer or something, and he was like, he did something for the king, and the king said,
Yeah.
"Name anything that you want, right? And I'll give it to you." And he said something along the lines like, there was like a checkerboard. He goes, "I just want you to double the number of like grains of rice to give me on every piece of the checkerboard."
Right.
And like the workers that were putting this together, you know, for the king to give to the farmer, went back to the king and like, "We can't do this. There isn't enough rice grains."
Exactly.
If you think about, well, I'm just doubling a single grain of rice over like a checkerboard, it like doesn't seem crazy. But once you actually do the math and you see that outcome of just 1% improvement every day, you are a different person. And I've seen that because, once again, I talked to you about, you know, from where I've come from a year ago to today,
Yeah.
by me changing my life and just focusing on being the best that I can every single day and improving every single day. Like that's the best thing that you can do.
Absolutely. No, no, that's perfect. And do you want to go through maybe one or two more stocks? I know you had NVIDIA on your list, and that follows the semi theme. But is there any other high conviction names that you want to look at before we kind of wrap things up?
So let's just talk about, for me, right? Like for a long-term investment. Let's do, we've done a bunch of semis, so let's just stick with that theme, I guess. Or you know what? Here. One that is not sexy at all. Moodys, right? The first thing I do when looking at a stock is I pull up a monthly chart. So Moodys, like, let's just, the fact that we have this downtrend here, this was obviously '08, right? So this is going to be an interruption of the compounding.
Right.
And I'll show it on a different stock too, but what I'm looking for in my long-term investments, I mean, this thing is up and to the right,
Exactly.
right? On a monthly chart. There's very, I mean, this may have been, I think Greece was around here, you know, like this is just up and to the right on a monthly, right? A lot of the time, you really, once again, don't need to overcomplicate it. Just like, this is telling you this thing is compounding earnings. Let me just show like another one, like TXN, for instance, Texas Instruments. Once again, up and to the right.
Yeah.
And so a lot of these names, right? So let's go back to Moodys. These long-term compounders that I'm looking for, it's exactly this. That's how the stock's going to look like. So you don't need to overcomplicate it. Then, yeah, let me quickly pull up. You know, I have, so for Moodys, right? So Moodys right here. The way that and I'll show a quick example too. The way that I think about my long-term compounders is returns on invested capital. And over time, your returns on invested capital will basically mirror what your IRR is, right? And so Moodys is at a 5, and the better to do is really extrapolate that out further. I wish I had the 10-year average ROIC, but you know, Bloomberg only has 5 years, 24%, right?
Right.
And you see like these 3 and 5 year annualized returns of 30%, right? So, and consistent. I bet you if I went back further in time, Moodys probably has, and here, actually, the 3-year is right around 30%.
Right.
Right. So over time, your returns on capital are going to somewhat mirror your IRR. Right. And, you know, another, you know, quick proxy too is you can look at free cash flow yield and add that to your free cash flow per share CAGR. That's another way to kind of think about IRR. But the reason why, to me, your return on invested capital, both your return on invested capital and your return on incremental invested capital is really like the first and foremost most important thing. If I had to look at a metric, any single one metric, is because of this. What are we trying to do? We're trying to generate the best in class returns. So if I know empirically that generally your return on invested capital is going to equal your, your longer term CAGR, why would I deviate from that and look anywhere else, right? So that's why. And then if I go to, and this is something that I got from John Huber as like a quick example, I can kind of walk through why your return on invested capital over time is so much more important and drives the majority of your returns as compared to the valuation price you pay, right? So this is an example, and I put together two different examples for us to look at really quickly, right? So let's start with earnings power, right? If we're generating $100 of earnings power, and my multiple on that earnings is, say, 20 times for a reinvestment Moat company, right? You should have a higher multiple if you can reinvest your earnings at higher rates versus a optically cheaper stock, 10 times, right? Same earnings power, half the beginning valuation, and I'm at, half the current valuation, so cheaper price paid for the same earnings power. Sounds great, right? But the fact is my reinvestment company can reinvest 100% of its earnings, whereas this company I'm getting on a bargain can only reinvest 50% because they either don't have the optionality, they don't have the different growth verticals, or because if they reinvested 100% of their dollars, they couldn't return the same 10% on that other 50%, right? So it would be a destructive use of capital, right? So, but my reinvestment company, they can earn 25% on those earnings. So what I'm seeing here is I can take every year my $100, I can reinvest 100% of those $100 at 25%. Versus my bargain company for the $100, I can only earn 10% on 50%. The remainder will be given back to my investors through dividends. Right. So that's what's happening here. My year 10 earnings power is simply the current earnings power times 1 plus, your CAGR on the earnings power, so 25%, 10% respectively, times whatever you're keeping, raised to 10 years. So that's how I'm getting to my earnings power here. I'm bringing down my multiple from 20 times to 15 times, right? And I'm increasing the multiple for my bargain company from 10 to 15 times. Even doing that, my IRR for my more expensive looking company today that has a reinvestment mode is going to be significantly higher with a higher multiple on my invested capital. That's over double the bargain company, even though I had 50% multiple expansion, right? So this is an example that's proving out really simply that your return on invested capital, your return on your earnings power here is really the determining driver of your returns over the long term, as opposed to your multiple paid, right? If I go down, and so basically this, what I'm trying to do in this example here is just kind of crosswalk to what would that valuation discrepancy up front have to be for my IRR to be the same? I get paid 35 times today for a company that can reinvest 100% of its earnings at 25% and then get the same IRR as a company that's earning 10 times, right? And so that's why for me, your return on invested capital is so important, because you could pay an egregious multiple today relative to a comp at 10 times, and you can shake out to have the same IRR, right? And so if I even did this at like 20 years, what I bet you're going to see, I don't know if I ran it out that far. Yeah. Is that number? Look at, and this is exponentiality again, right?
Right.
And so I don't even know, like, I mean, you could pay something maybe egregious then, right? Like, see how crazy that gets as you get out to really further time horizons?
Right.
So over 15 years, it could be 100 times, right? And so once again, it's like it's that if you think about a exponential chart, right? How all of that really major growth happens in those latter years.
Right.
That's what you're seeing in this example, right? And so like for me, like that's just a really informative view of what is happening here with these guys, right?
Yeah.
And you can even like look up how beautiful Microsoft is. Once
Right.
Satya, Nadella, like I mentioned Nadella earlier, Nadella is going to go down as being like one of the greatest CEOs of all time. I'm pretty sure he took over for Ballmer like around here, and look at the chart,
Right.
right? Even like at Costco. I mean, Costco just, geez, like what else do you want, right?
Right.
And so if you're a longer term investor and you just you don't want to think about, you know, the daily fluctuations of being an active investor, your return on invested capital will be a great guidepost.
That's awesome. You're basically looking for just the stocks that have performed over the long term, just ride that trend as long as it keeps up. And yeah, I think that the spreadsheets that you showed was a great. It basically showed the great point that stocks are expensive for a reason. If you're able to grow your earnings and sales and all of that at that ridiculous rate, there's a reason that you're trading at 100 PE or whatever it is. It's not an expensive company because of that growth. That it's just so substantial, right?
Right. And once again, like expensive, like, what does that mean?
Right.
Expensive today or expensive in 5 years?
Exactly.
Right. If expensive in 5 years means that, I think expensive in 5 years means that you're not getting paid for the multiple you made, right? And that's going to happen more for your optically cheap companies more than your optically expensive ones, right?
Great point.
It's just like people that are, you know, they're obsessed with, you know, combing through the 52-week low list, right? There's a reason why these companies are underperforming. It's because they're not creating the value that, you know, the companies like Costco are creating.
Exactly.
Right? And so like a Costco or even like, you know, a Fastenal, like, you know, these companies, they're not sexy. They're not fun, right?
Yeah.
But if you are a longer term investor and you want to build some, you know, some kind of portfolio that is going to be easy to, you know, have over the longer term, you really won't go wrong with just focusing on returns on invested capital, because the return on that return on invested capital is the creation of intrinsic value.
Right.
And over time, the stock will be worth its intrinsic value.
Gotcha. And I think Domino's is one that's been a long-term
Domino's,
leader.
yep. Yes, sir. Absolutely. It's just much more aggressively.
Yeah.
Look at that. That's insane. But you know, it's funny you mentioned Domino's. I don't think I have a screen up, but if I did like this, if I went to, I think they're in the S&P, right?
I think so. Yeah.
I believe so. If I go here and I go to S&P 500, and if I sort by 5-year average return on invested capital, look what's number two.
Wow.
Look at that. Right?
Crazy.
Like we just did this off the cuff. And Domino's, like that's where they are. And I mean, we didn't talk about like MasterCard, you know, MasterCard and Visa, same thing. S&P Global is you know, a Moodys, is part of that Moodys. Well, before I move on, Text Instruments right here. Right. So I can just talk quickly about, you know, why Moodys. Moodys is structural oligopoly, has regulatory capture, right? If you're going to issue debt, you have to get rated by one of the rating agencies, and there are only three. There are only three places to go. And because they are a structural oligopoly, they have pricing power, right? And I think it's like they've been able to raise prices like 4% a year for like ever, right? And so, you know, like those are the really simple things to look for, that I think that if you just do that, you really can't go wrong for a long-term goal, right? I can't tell you what you know, what Texas Instruments will do over the next like couple months. And if you like TXN, like look at this. We were talking about, you know, how semis are like rolling over, or like the whole market is been so volatile. Like look at Texas Instruments. It's boring as hell.
Yeah.
Like like come on, like do something. But no, they're just gonna continue to grind higher slowly but surely. And Rich Templeton, it comes down to capital allocation. The guy's one of the best capital allocators in the world. 58% return on equity. What else do you want, right?
Right.
And so yeah, like that's this kind of the longer term investing is a huge interest of mine because it really is like how can I compound capital to create just generational wealth, right?
Right. Right.
And that's if I go back to the spreadsheet here and I just do a simple, if I take $1, right, times and I'm doing if I want a 30% CAGR and I'm going to invest for 40 years, and I have to do equals, right?
Yep.
With Excel. That $1.
Not a bad return. Yeah.
Yeah, you're doing okay, right?
Yeah.
And now, listen, 30% is egregious.
Yeah. Yeah.
Let's do 20%, right? That $1 still turning into $1,500.
Right.
Right. So, if I think that active management has a place. I think that we were talking about trading around positions. You can really truly create alpha. But I also do think that it's good for people investing, right? We talk about risk. Risk is the number one thing. You shouldn't be investing with money that you don't have, meaning investing with money that you rely on for your life savings and for expenses on daily living.
Yeah.
I think that it's also probably a good idea if you think about IRAs, 401ks, to kind of think about this longer term structure here. If you can have a part of your net wealth that's just in these longer term compounders while you're still able to do what you love, which is this really just challenge of finding these high growth companies, like these like Rumpel talks about these life-changing companies.
Yeah.
You can also have some money here in these longer term compounders and do really freaking well.
No, 100%. And even if you go back to MarketSmith for just a second, if you look at the fund ownership, you can see a lot of the top growth funds are kind of allocating a certain portion of their portfolio to these longer term compounders as well. So you're seeing what the pros are doing right there.
Exactly. Yep. Exactly right. Isn't that cool to see Danoff in Texas Instruments? This name's not sexy, but you know what's funny too is look at this. We see the accelerating EPS to sales growth.
Yep.
So yeah, I mean you won't find it maybe everywhere, but I think the other thing too, Richard, and I was mentioning to a couple buddies of mine the other day, but what's so impressive about you is this your work ethic and the consistency. People, if you just put in the time and the effort, you can create life-changing wealth for yourself. All it takes is if you're just going through charts, even Onto, look at Onto, right? And you go to the daily, Onto once again had this breakout, so now they're coming to retest. Look at so we're sitting on top of the 21 and the 50. Is Onto going higher? If it does, this is another one of those textbook type of setups. Right. And is it once again, this accelerated EPS growth, right? The sales growth, some of an issue, and then Corvo, I think, is another one. Look at this sales and EPS growth, right? And it has a cup and handle. So if you're just going through charts, which is I think a good practice for everyone to do, and what I need to do more of is going back in time and following stocks as they go forward in time. But if you're just going through charts, you're not going to mix the names. Another one, this one was this is the name I screwed up on. I screwed up on it. Yeah. And this was more just I didn't play the options right. But if I come here to the daily, maybe it might be easier on the weekly for me to show you. When it broke out of this flat base here, I was waiting and waiting and waiting, and I got shaken out. It was probably right around here. So a couple weeks before this explosive EPS move out, right? But I mean, Crocs is another one. Look at this base, explosive move up. And so if you're just going through charts, you're gonna find these big home runs. It's inevitable because there are enough. Yeah. If you just have to put in the time and effort and just truly have the intellectual curiosity to find these names. And if you are truly curious and you truly love investing, you're going to be successful over the long run, right? Because, and this is just something I fundamentally believe in.
Mm-hmm.
I think that everybody is capable of achieving anything they put their minds to. I
Mm-hmm.
think that anything else is excuses. And in America, we maybe not pure capitalism, but we still have a capitalist type system. And so, given that, you're going to have value creation by these private companies all the time. And we are able to participate in that value creation. So, I think that anybody can truly create life changing wealth if you put in the time and the energy and you believe it. You have to believe it, right? And
Mm-hmm.
so, if you believe you can do it, I truly believe that anyone can, they can generate life changing wealth.
Absolutely. And that brings me to really the last question that I always ask. What is your kind of advice for new investors, new traders, to try to accelerate their learning curves as much as possible?
Yeah, I think it comes back to that intellectual curiosity.
Mm-hmm.
I think if you're intellectually curious, right, not only are you going to be looking through charts all the time,
Yeah.
but you're also going to be trying to learn new things all the time. And once again, if we're about competitive learning, that's really what it's all about.
Mm-hmm.
And so my advice would be stay hungry, stay humble, right? That's like those two things are so critical. I will take somebody that has hunger and desire, work ethic over somebody that went to Harvard or Yale, whatever it may be, every single time.
Right.
Partially, I'm biased because I didn't go to an Ivy League school, right? And everywhere I've gone is just truly through hard work and just
Mm-hmm.
grinding, and just running into a brick wall after a brick wall until it's falling down, right?
Mm-hmm.
And so if you stay humble and hungry, you try to get 1% better every day, and you really view investing or anything like that as everything in your life is just you're trying to get a little bit better every single day,
Mm-hmm.
right? If you have that mindset, then you're going to do well in the long term with anything that you try to do in life, whether it be investing or something else.
Yeah.
And I'll say this too, you know, nobody's ever done, I forget where I heard this quote, but nobody's ever done extraordinary things by doing ordinary things. And so I'd recommend always challenging your comfort zone, always trying to go outside of your comfort zone, because I think it's that, it's that line between comfort and discomfort that you
Mm-hmm.
can grow as a person.
Mm-hmm.
And I really do like this just fits in with investing, but I really am trying to be the best version of myself, right? Not comparing to Richard, who I can't hold a candle to when it comes to trading, or anybody else, right? Do not compare yourself to others, because
Mm-hmm.
this is another important lesson I've learned, and people should really take to heart, is that we all are on our own timelines,
Mm-hmm.
right? Somebody could be like, there could be someone in my age that they're not going to hit their stride investing until they're 40. There were guys that, like you're light years ahead of where I was at your age, right?
Mm-hmm.
And so it's just really remembering that we all are on our own timeline, our own timelines. There's just no replacement for hard work and for experience. And you have to put in the hours. There are
Yeah.
no shortcuts in this business, right? And you have to put in the hours, the time, the effort. And the only way to do that is to truly love it.
Yeah.
You have to love it.
Yeah.
And if you don't, maybe, indexes are, a better option, right? But if you love what you do and you're just trying to get a little bit better every day and be the best version of yourself, then you're going to be successful with anything you put your mind to.
I think that's a perfect way to end it. Christopher, thank you so much for your time. I learned a lot. I'll really enjoy watching this back and editing it and taking some even more notes. So thank you so much for taking the time coming on my channel. And yeah, I really hope we can do this again and go through even more examples, because I love hearing your thought process, especially on the fundamental side of things. And once again, those critical factors, how you focused on those, that really stood out to me. So yeah, thanks so much.
No, thank you, Richard. I look forward to doing it again, and obviously just continue to pick your brain on all things investing.
Absolutely. To everybody watching, I hope you enjoyed. Remember to leave a like down below and subscribe if you're new to the channel. And Christopher, where can people reach you if they want to ask you a question or just get in touch?
So you can find me on Twitter. My new Twitter handle is the number two, chase greatness. A little bit corny, but it's what I'm really trying to do is,
Yeah.
I really am trying to chase greatness. So you can find me on Twitter that way. You can find me on LinkedIn, just my name, Christopher Seifel. You can email me.
Hmm.
I can, give you my email for the show notes. Yeah, and I've had to shut down the newsletter really because just because of the job, but
Yeah.
more than happy to, I've taken calls from guys all the time because I truly believe in paying it forward. I didn't really have any help getting to where I am. And so I know how hard it is, especially for people that aren't from those like Ivy Leagues and the 2+2s, et cetera.
Yeah.
So, if you love investing and you're young, hungry, passionate, ambitious, reach out and more than happy to provide any sort of help and guidance that I can.
Awesome. And yeah, I'll have all those links in the description so you can just check out Christopher that way. And other than that, thanks for watching, and we'll see you guys in future videos. Thanks.